All right. Good morning, everybody. Hey, welcome to the August Note Weekend class. Good morning, Larry. Good morning, Tony. Happy Saturday to everybody. Join us live. We're live on Zoom here. We're live on YouTube. I'm also tempted to try to see how it works with live streaming here to TikTok as well. So I encourage you, if you're watching on any of the live streaming or catching the replay, awesome. Glad to have you. But if you are watching this live, you can go over and watch for free at noteweekend.com. And tune in. That'll be the better way to ask questions because we're going to be going through a variety of topics over the next couple hours. How to find non-performing notes, what are notes, how do you dive into that aspect of things. We'll talk about different vendors, how to evaluate deals. You're not going to learn everything about note investing in 3 hours. Let's just put it that way, right? But it's a good Cliff Notes version to our virtual note buying workshop that we have coming up here in September, the 27th through the 29th. That way, that's the whole full day on finding deals, a whole day on funding deals, and a whole day on flipping deals and exit strategies and stuff like that. So, want you guys to take advantage of that because we got a special promotion. If you're hanging around to the end, there's a very special promotion on that one. And we're excited to have that class take place in September. But anyway, that'll be on Zoom. It'll be live via Zoom here for 3 days as well. But anyway, guys, welcome to Note Weekend. My name is Scott Carson. I've been an active note investor for over 20 years. It's hard to believe that, 2 decades since I bought my first note. I like note investing. What is note investing? Well, most people are familiar with the niche of real estate investing where you're buying real estate of some sort. Well, note investing is where you're literally buying the mortgage debt that controls the real estate behind it, right? I buy notes directly from banks, hedge funds, other private sellers, other investors. Most of the paper or mortgages that we buy are secured by real estate. It's residential, commercial property, but we're in the first senior lien position. So, I'd love to know where you guys are joining us from because we've got a variety of people. We had about 55 people register for the Zoom call. Who knows who's watching online right now, but if you let me know what part of the country you're joining in, what you're used to investing in, or if you're brand new, that's okay. We all got to start somewhere, right? And the best time to plant a tree was 30 years ago, right? Well, the next best time to plant a tree is right now in today world, because I know a lot of people are frustrated with what's going on. Interest rates have gone high. Real estates have been at high. I mean, the average just came out yesterday that the average price for a home was $422,000. That's up. That's a record. The last like 4 quarters in a row, that's been up and up and up, right? It's hard to find foreclosures at big discounts. What I like about note investing is, hey, good morning, Jefferson. Jeff from Dumas, Arkansas. Glad to see you, buddy. We got some friends up there. Tony Jones from Fairfax, VA. Good morning. Glad to see you guys there. I am trying to monitor the live stream as well here. So if you want to comment on there, feel free to, as we are trying to stay on top of that with everybody. Who else is on here? Larry from Norfolk, VA. Well, Larry, you and Tony need to meet up. Fairfax, Norfolk, you guys aren't too far from each other. And that's the beautiful thing, is we're not just buying in Austin, Texas, which is home. We're actually buying in about 20 to 30 different states across the country, depending on what's going on and what type of asset class that we're buying. The great thing about what I love about notes is that we see deals on a regular basis without doing a lot of overhead. Yes, we're not spending time on Facebook ad clicks or direct mail campaigns. Hey, Sylvia, good to see you. Hey, Broward County, Florida. Glad you got my email. I tried to call you this morning, Sylvia, and the phone wouldn't go through. So, but anyway, glad you got the email with the connection. I was worried about that. But anyway, like I said, I've been buying for over 20 years. And what I have kind of niched myself down to for the most part is buying the non-performing notes. We still get plenty of inventory. Yes, foreclosures are down across the country. Totally down. Hey, Josh. Hey, Renee. Good to see you all out there as well. And Jim and Dutch. Some of the folks that are joining the comment online is awesome. Foreclosures are down, but buying a non-performing note doesn't mean I'm always going to foreclose. A lot of times we work it out with a homeowner. But that's the beautiful thing, is that being able to work it out gives us so many different exit strategies. And we'll go through that later on today for you guys, because there's a lot of ways to make money in the non-performing note space. keeping the borrower in the house, getting cash for keys, deed in lieu, getting a payoff. There's all sorts of settlements that you can do with that. But anyway, let's dive into this. We are honored at We Close Notes to be the number one, that's right, the number one investor recommended training for note investing, specifically on the non-performing side. There's a lot of people teach about owner financing. There's nothing wrong with that. That's a niche you can go into in originating notes. But I'm not going to get into originating. We're going to be talking about buying existing paper. Well, that way you don't have to worry about going through all the hoops of Dodd-Frank and making sure that CFPB is taken care of. Yes, CFPB, the Consumer Finance Protection Bureau, is important. But if you're buying existing notes, you're not on the hook for making sure that they're qualified. And, it's better paper when you're not the one originating it, when you're buying it in a lot of cases. So let's dive into it. So we host these Note Weekend trainings about once a quarter live. Sometimes it may be a little more, sometimes a little bit less. We were doing a monthly back when COVID kicked in, but we've gone to more quarterly basis, or we'll do a replay. I think we're going to get back into, as we get into the rest of the year, probably doing back to monthly as things are popping up. But ask questions. Feel free to ask questions. We'll always try to answer them, but please keep your questions on point to what we're discussing about, because we'll go through a variety of things. Like I said, how to find, how to fund, and how to flip these. We are recording these sessions. Yeah. So that you guys, that if you're registered at noteweekend.com and via the Zoom link, we can send you the replays and you can watch the full thing ever. So if you guys are just joining us live there, hi Bridget, hey Spam, hey Big Dilly, hey Michelle, go over to Note Weekend and register. Either join us live or just register, and we'll send you the replay of this as well. I want you to respect your fellow investors. Sometimes we have people on here that ask questions, and that's okay. I want you to ask questions. The chat roll is open, but respect people. Some people have different experience levels. Some are more advanced. Others are brand new to this world, and that's okay. That's what this class is designed for, is just to help you kind of get the ball rolling and learn about note investing, learn about buying performing or non-performing notes. So what is a note? We'll get in that in a second. And we encourage you to network with us and others. All right. If you're here live, feel free to type in or share your LinkedIn profile into the chat roll. So everybody else, and make sure when you share it with everybody, not just the panelists, but share your LinkedIn URL into the chat roll so everybody can connect with everybody out there. But we also have a Facebook group, the Note Nation Facebook group. It's not very active. A lot of Facebook groups aren't very active, but there's about 1,100 members on there, and it's still a great place to ask questions. So when you do ask questions, they do get answered. And of course, you can always connect with me at talkwithscottcarson.com, or you can always email me directly at scott@weclosenotes.com. I encourage you, shoot me questions, go to talkwithscottcarson.com, book a time, a 30-minute session with me. I'm always here to answer your questions and help you make sure that you understand what's going on. Some other resources out there, free resources. Who doesn't like free, right? We have, like I said, we've got the Facebook group. We do a Monday night webinar at nonightinamerika.com. Sometimes they're pre-recorded, sometimes they're live. You can always register for nonightinamerika.com. That way you're always up to date with what those are going on. We do have the #1 YouTube channel for note investing. That's at weclosenotes.tv. That's weclosenotes.tv out there. Let's see here. Confirm. All right. I don't know what's going on there, but anyway, as always, you can always book a call at talkwithscottcarson.com. And then, of course, we've got our podcast, the Note Closer Show, out there anywhere that podcasters, anywhere you listen to podcasts or videos, stuff like that. We're really, really excited for the amount of growth taking place on both our YouTube and podcasts. It helped us make this the #1. We do have an upcoming workshop, note buying, virtual note buying workshop coming up in September. You can get signed up for that at notebuyingfordummies.com. We do have a monthly membership that really does weekly coaching calls, provides lists of notes and other resources for you. All right, at noteumbrella.com. So, and then Note Camp Live is a mid-year convention. We haven't done it the last 2 years, but we will be doing it here before too long. And then, of course, we have a one-on-one coaching. But anyway, let's get into the nuts and bolts of what's going on here. The types of notes that we do and the types of notes that you can buy or invest in, there's a variety of them, because most people think that just when they hear note investing, they're basically owner financing a property. And people have a tendency to like, oh, I don't want to finance a property for 10, 20, 30 years. I was just talking to a seller about 2 weeks ago, we were looking at some land, and I asked him if he was willing to finance. So, I don't want to carry finance for 30 years. I was like, well, I'm not asking for you to carry it for 30 years. I'm thinking for like 2 years, 3 years till interest rates, or I can fix up the property a little bit, fix the land to make it more valuable to move it at that point. Because I don't want to, nobody's going to finance it as it is right now. And the guy's been holding on to it for over 5 years, not doing anything. Okay. So what we like doing is, like I said, we like buying that debt direct from the banks. And let's see here. Larry mentioned something. He was grateful for the opportunity to connect. I'm about a year into note investing and done about 8 notes. Congratulations there, Larry. Looking forward to learning more and doing more deals. Okay, awesome. Thank you there for that. Good morning, Ron. Good morning, Kath. Good morning, Bemet. So anyway, so there it comes down to, when you hear about notes and notes available for sale, it kind of comes down into two categories. What are those two categories? One is institutional debt, where that note, that mortgage has been originated by a bank entity of some sort, bank, mortgage company, something like that. And then you have non-institutional debt, which is the owner finance stuff side. Like anybody's got a house for sale can originate. Okay. And those kind of vary. So like on the residential and institutional debt, you have residential first liens. These are, you can buy performing notes. You're not going to really buy a performing note from a major bank, but you can buy performing notes from other investors, hard money lenders, and a variety of other folks that have stuff on their books, stuff that was once non-performing that is now re-performing, and they're looking to sell those off. You can also buy non-performing notes from just about anybody. What's a non-performing note? That's somebody where the borrower has stopped paying. They're non-performing. Okay. Usually we're buying notes that where a borrower hasn't paid in usually at least minimum 90 days to 120 days. Usually it's 6 months or longer, sometimes up to 6 years, we see in some cases. All right. You can also buy junior liens or second liens that are performing or non-performing. I don't buy a lot of seconds. Seconds are a lot smaller inventory out there because there's been a lot less originated. All right. They used to be you used to be able to buy them very, very cheap back in 2008, 9, and 10 because they were in a riskier position, in a second lien position. Of course, values dropped and a lot of those seconds were underwater. And as values have appreciated over the year, those seconds now are no longer underwater. They're over encumbered, and there can be full payoffs. So they're not the big discounts. I mean, people come to me like, I want to buy a portfolio of seconds for like 5 cents on the dollar. I'm like, well, that's great. You're not going to see that. I got 50 grand. Well, I might get you 1 note now, not 10 notes. Okay. I just like being in a first lien position because I can't get wiped. If you're going to be buying a second or junior lien and it's behind a non-performing first mortgage, that's a very risky position to be in. Okay. Not a good spot to be buying junior liens behind non-performing notes. Okay. All right. Let's move on here. Commercial properties, performing and non-performing. There's a lot of commercial stuff. If you've been following our YouTube videos or TikTok videos, you see about us featuring a variety of properties that are going to the foreclosure auction. These are non-performing notes. We did one this morning talking about the foreclosures in Texas. 476 commercial properties are going to go to the foreclosure auction on Tuesday when everybody gets back from Labor Day. 2,800 residential properties up for foreclosure across the state of Texas. Okay, those are non-performing notes. People have stopped paying on them, and the bank is foreclosing. We have a lot of distressed commercial debt out here too, where loans have matured and the borrowers, property owners, are trying to refinance, but we all know interest rates are a lot higher than they used to be. That's what's causing a lot of these commercial properties go to foreclosure, is that the rates are just so much higher than they were when they originated 3-4 years ago. I mean, that's what's happening, especially in a lot of these multifamily properties, is they did 2-3 year loans with floating rates. Well, the rates have changed. They had money for the purchase of the property and then the rehab of the property with the hopes that they were going to regentrify the property and resell it in 3 years at a huge appreciation. Well, no, that's not the case. Well, when your interest rate goes up in your mortgage, your loan payment goes up 2-3 times. That reduces your cash flow. That reduces your reserves that you have for rehabs. So that's why you see a lot of these larger apartment complexes going to the foreclosure auction that were bought 2020, 21, 22, 23. They just financed it the wrong way and weren't thinking about, well, what happens if this happens? And, that's happening all across the country on a major level in a lot of cases. Some big players are literally getting wiped out because they didn't finance the property. So those are non-performing notes that if you have the money, you can go in and buy those notes at a discount and try to work out. We'll get more of the extra strategy later on. Owner finance notes, you can buy owner finance notes. I had somebody contact me yesterday, like trying to buy owner finance notes from owner people that originated. I'm not the biggest fan of buying owner finance notes. Or, well, let me take that back. I will buy owner finance notes, but I just don't do a lot of work in marketing for them. Here's the philosophy behind that. Some people will tell you, like, oh, go find tired landlords that don't want to be landlords anymore and have them owner finance the property, set the note, and sell the note off. You can do that. But what happens is most note buyers want to see an owner finance notes with some sort of seasoning, or as we call that, payment history, where the borrower has paid 6 months of on-time payments. You also want to make sure that that owner finance note is structured properly, usually at 7-8% or higher, depending on where interest rates are. You almost need your owner finance note to be at 10% or greater. Borrowings bring something down 10% usually. They need to usually have a decent credit score of 620 or greater. If you want that note to be sold, you also need to have that note listed with or have a third-party servicing company handling the payment collections and the statements. I get people call all the time, hey, can you buy my note? And I look at it, I'm like, okay, first of all, there's no servicing on it. So you're basically collecting checks and just depositing. There's no real like paper trail. You didn't write this on a napkin, but the note you wrote really is okay, but there's no financial numbers. Can the borrower afford this? Or you over finance the property at 105%, and I'm only going to give you 80 cents on the dollar for the note. You're going to take a big hit. Whereas if you've gotten some down payment and then structured the note for a first and a second, I can buy that first closer to value, and you hold that small second for cash flow. So there's a variety of ways to do that. Contract for deeds is a non-institutional debt. There was a lot of them originated, back in 2014 with all the HUD foreclosures, the small lower value properties. You see some contract for deeds originate today. But the thing is, with contract for deeds, those are like a 30-year mortgage, but the deed stays in the name. The deed of the property stays in the name of the seller. The deed doesn't transfer to the borrower until the deed or contract is paid off. As inscribed to proxy listing in your, I don't understand that. Okay. So, anyway, I don't know what's going on with that, dude. Anyway, so as we dive into more of the note investing things that we're going through, we'll talk more about some of the different products that are available out there. Some people like lease options. Some people will dive into buying those or creating those. We don't dive into any lease options. We want to be where it's a mortgage or a note of some sort. Okay. Now, where should you focus? What's going on in today's market that you can dive into and sink your teeth in? Now, most real estate investors, they want to invest for a variety of different things, either cash flow versus property, right? I want to own more property, or I want to get cash flow. There's nothing wrong with that. But buying property, you can be property rich and cash poor. That doesn't put you in a good position. That's what's happened to a lot of people. They got equity, but they don't have any cash flow, or the cash flow they have is minimal. I mean, I always talk to I got a lot of real estate investor friends that have rentals, and they're, I'll get excited if I'm going to make $200 to $300 a month in cash flow. I'm like, that doesn't excite me at all. $203 a month if I've got to handle, management, toilet sinks and trash outs, complaints, all that stuff. No, that doesn't get me excited. I like cash flow, especially on the notes, where if I get at least $250 a month, I'm not handling 200, I'm not handling toilet sinks and trash outs. Nobody calls me when the AC goes out. The borrower is responsible for that. So I think cash flow is always one of the most important things you got to have. And yes, you can use notes to acquire property, but you don't own the property if you buy the note. All right. Your note is the collateral of the loan. So if the borrower stops paying, then you have the right to foreclose and take the property back. You always got to worry about your return on investment. That's an important thing. Is it worth your time? I always say you also have to worry about return on time, right? Inventory too. There's a lot of folks that are looking for specific inventory. Like I get phone calls all the time. Hey, I want to buy non-performing notes on apartments at 100 units or less. Okay, I get that, but so does everybody else. And those aren't always, you're not always going to see those at deals that you want. Or I want to buy in California. Okay, that's great, but that doesn't really make a lot of sense to buy in California because it's a little crazy out there and it's harder to foreclose. So understanding what's available, what states have inventory, and also getting outside of your comfort zone. There's some people that um, just want to do it in their backyard. That's not always the case. I'm in Austin, Texas. Austin, Texas is a great place, but unfortunately, we don't see a lot of non-performing notes here. If I just wanted to focus on here in Central Texas, I would have gone bankrupt a long time ago. This is why we buy in about 20, 30 states. But the beautiful thing is that when you have a bigger buyer box or buyer geography, you have more deals coming into you. And because I live here in Austin, doesn't mean I have to fly out and take a look at that property. There are vendors that'll do that for you. Pricing varies too, depending on if it's performing or non-performing, where it's located, how long the foreclosure time frame is. There's a lot of stuff that you have to keep in mind. Then you also have to look at time. How many hours per week are you going to be putting into your business? How much time per week do you have? You know what I mean? If you've got only a few hours a week, you probably don't want to be doing like a lot of non-performing stuff that's going to take a little bit of your time. You probably want to be focused purely on performing paper that you can sit with a servicer and almost kind of, automate it and be 100% passive for the most part. All right. Then one of the big things I like doing, hey, good morning, everybody, is having a system or a business plan to kind of follow. So if you go over to our YouTube channel and look for the video 100K in 12 months, that's 100K in 12 months, you should find an amazing, about a 30-minute video on how we have structured and show people how in the next 12 to 24 months, depending on what they buy, what their focus is, they can be making six figures as a note investor. It's very, very possible to make six figures and beyond. You got to put some time into it. You got to learn how to market. There's some things that you got to do just like anybody else does out there to get the ball rolling. So lots of different kind of variables. That's okay. Don't be scared. Don't be confused. Note investing can be a very rewarding thing. It's not a get rich quick. I'll tell you that right now. It's a wealth building aspect without having to do all the headaches of toilet stands and trash outs, rehabs, that stuff. Yes, do we end up doing some rehabs? Yeah, we got a property right now we're rehabbing. We're in the process of selling. We had to do some foreclosures. When we're buying non-performing notes, foreclosures is just part of the business. You don't do it yourself. You hire servicers and attorneys to help you out with that. But out of all the notes that we buy, about 70% of the time, if they're occupied, 70% of the time when we buy and through due diligence, we're able to keep the borrowers in their houses and modify the payment for a cash flow, a return on investment that makes sense for us, our investors, but also helps that borrower stay in the house. Now, the other 30, 40% of the time, you're probably going to end up having to get deed and lose, cash for keys, and then a mixture of foreclosures having to foreclose. And foreclosure timeframes vary across the country. Costs vary a little bit. The faster foreclosure states, like here in Texas, Georgia, $1,500 to $2,000. The longer judicial foreclosure states like Florida, that could be $5,000. New York, New Jersey. New York takes 3 years. I don't buy there. Okay. New Jersey can take 2 years. I don't buy there. Lots of opportunity in other parts of the country. Don't be so scared about judicial states and going through the process. That's why we hire professionals like attorneys and servicing companies to help hold your hand along the way. Okay. So a judicial foreclosure, if you don't know what that is, that's literally in a state that requires you to go before the courts and file foreclosure. They have longer time frames. Usually the minimum on a judicial foreclosure can be 6 months up to, like I said, 3 years with New York, New Jersey. We try to stick with states like South Carolina. We'll look at Florida too. We've bought a lot in Florida the years that are about 12 months or less. Sometimes it'll drag on. Sometimes you have a borrower that'll drag it out, or nobody expected COVID to happen where it really dragged foreclosures out for quite a way, right? But on a judicial foreclosure, usually the minimum you're going to see is about $3,500 to take care of that foreclosure. A lot of the judicial states are east of the Mississippi, but you also, when you're buying judicial notes or notes backed by judicial states, you're going to get a little bit more of a price break than buying in the fastest foreclosure states out there like Texas. Non-judicial foreclosures are non-judicial. Basically, once that borrower is 90 or 120 days late, you basically publicize the foreclosure and you're rock and rolling. Okay. Shorter time frame, basically anywhere from like 21 days in the state of Texas. Tennessee's a non-judicial, it's about 120 days there. It's less expensive. Like there are here in Texas, I can basically foreclose for about $1,000 to $1,500 and be done with it. Okay. A lot of the Non-judicial foreclosure states are west of the Mississippi. Don't get me wrong, there are some that are east. Okay. But you're going to end up probably paying a higher price point. I get people that come to me like, well, I want to buy in just non-judicial states, like the fastest foreclosure states. I'm like, okay, that's fine. But you're going to be probably paying in the high 60s to 70% of either the balance or the value because it is a faster foreclosure state. And there's nothing wrong with that. I mean, I'll pay a little bit more for stuff here in Texas because it is the fast foreclosure. And when you figure out that what you can foreclose and then flip the property if you have to take it back, it's your velocity capital is faster, so your returns can be up higher. Don't get me wrong, I've bought stuff that I knew was going to take me a year or two to foreclose in other states because the borrower was that, but I was buying it at a bit cheaper price that made it valuable for me. Okay. Now, people always ask me all the time, do you need a license? Do you have to be licensed to buy notes? And the question that is yes and no. It depends, right? It depends on the state that you're in. Most of the time, if you hire a loan servicing company who's licensed to collect debt in that state that you're buying that note in, that usually solves the problem. Okay, you don't need to have a license, special loan note buying license. Some states, though, do want you to have like a mortgage broker's license. Like Georgia is one of those states. Like if you're buying outside of using your self-directed IRA, they want you to have a mortgage broker's license of some sort. Well, we get around that by just buying through one of our contacts, our friends, our vendors who has a mortgage broker's license, and they get a piece of the deal. Okay. States like Ohio, if you're buying seconds there, they want you to have a specific license. Chicago or Illinois, they want you to have a different debt collector's license than from your servicing license. That's a $750 fee to the state, and it's good for 2 years. All right. But most of the states that you're buying in, if you're servicing company, third-party servicing company that you're paying $25 a month per loan for a performing note or $90 a month for a non-performing loan, as long as they're licensed in that state to collect, you're usually doing pretty well. Okay. Let's see here. Oh yeah, Oregon, Washington, Massachusetts, Maryland, they're all got specific licensing issues. California, if you're buying notes and selling California notes to California people, they want you to have a separate license on there. Okay. So, but it's nothing to worry about. Most of the states that most of the states that you're seeing product in, hey, your servicing company covers that for you in the most part. Okay. All right. Like I said, guys, if you are joining us here getting a little bit later on, feel free to type in the chat roll where part of the country you're joining from. We're diving into this stuff on the note investing side. If you're watching the live stream, make sure to go to noteweekend.com to join us live here in Zoom so you can join us all along the way. Okay. Now, there are servicing companies out there, as we'll get in a little bit later, that want you to have a portfolio before they work with you, but there are plenty of servicing companies that like working with new investors, like Allied Servicing out of Washington State, Madison out of Reno, FCI's OK out of Anaheim Hills. There's a few others out there. I mean, there's a lot of servicing companies, some particular that only want you to have 100. If you have less than 100 notes, then you're going to probably be paying like a $5,000 a month minimum fee to me. So keep that in mind. Nothing to be concerned about. You don't need to go out and find a servicing company before you buy a note. Find a servicing company as you're going through that finishing process in your due diligence, and that's an easier way to do it. Okay. You don't need to go set up that duck and all these other ducks in a row before you start buying this. There's a few requirements to get the ball rolling. You want to have an LLC of some sort. You want to have, that's an important thing. Don't buy in your own name. You can buy in your own name. You can buy in your IRA. I would highly recommend you buying an LLC of some sort. We'll get that later on. Okay. What are we seeing in today's market? We're seeing reperforming notes. We're seeing non-performing notes. We're seeing performing and non-performing contract for deeds. Hey, what's up, man? Let's see here. M. Rolozone. I'm in San Antonio, Texas, to work foreclosures. I'm looking to learn how to create notes. Okay. Well, book a phone call with me. Talk with ScottCarson.com. Creating notes is not bad, but it's not as easy as you would think that to be, especially if you're looking to flip those notes immediately. You're going to want to have some seasoning on those notes. It's important to make sure they're structured properly too. So book a call with me, talk with ScottCarson.com or join us here on NoteWeekend.com. A lot of non-performing commercial notes. We talked about that a few minutes ago. That's what's available too. Of course, there's some big numbers on that, 30, 40, 50 million. Some of you are like, I can't afford that. That's fine. There's a lot of funds and companies out there looking for that stuff, so you can often Bird Dog wholesale that stuff if you get it under contract. But there's still plenty of smaller balance stuff available for you, ladies and gentlemen. A lot of the trades that we buy are one-off notes, 50, 60, $70,000 or less. We had one of our coaching students bought 20 notes that they invested basically about $240,000 of their own funds. And it's yielding about a 30% cash and cash return to them by buying that performing or semi-performing paper. Okay. You can go to different platforms out there. There's not a note MLS per se where you can go look at all the stuff, but you can go to like auction.com or 10x or exchange.loans or PaperStack or a few other websites out there. Some notes available. I don't usually buy off of platforms. I'm buying direct from banks. So I get lists of notes sent to me from these banks on spreadsheets week in, week out. That we do. Let's see here. Which properties you thought was a decent deal that you've posted? It all varies. John, that's a good question. On the individual residential notes for the most part, I'll tell you if I think it's a pretty good deal. All right. There's been some stuff here in Texas been good. There was some stuff outside of Texas that's been good. Some of these bigger commercial deals that are going to foreclosure, I don't think they're deals as they sit because they owe more than the property is worth in a lot of cases. So you could buy those from the banks, but you don't want to buy them before they go to foreclosure, unless you're buying the debt at a big discount. Okay, big discount below what you think value is. If you're buying it, 80% of the current value, not the old value. All right, that's got to, and then it all depends on an asset by asset basis. Part of the due diligence is so important about identifying deals. Not every deal is a deal. There's a lot of duds out there depending on what you're going to pay for it. Okay. Like I had a investor send me a portfolio of notes of some performing and non-performing. Well, he's trying to sell them at about an 8 yield. Okay. And I'm like, for an 8% yield, that's okay. But with interest rates being at 6.5%, 7%, it's not really a great deal. I mean, I understand you bought these non-performing, you probably bought them at a cheaper price. You're trying to squeeze all the profit. You're going to be holding this deal for a while. Okay. And yes, we do work with some groups and consult them on things. I had somebody that we're working on a deal right now. I mean, if anybody's, we're consulting with them, we're going to get 1% of whatever the funding amount is as a kind of a consulting fee in a lot of cases. Okay. But yeah, I mean, we got 20 years of experience doing this. And so that's one of the great things about what we do. We've seen a lot of things, seen a lot of good deals, seen a lot of deals we said nope. We also saw a lot of deals that we said no to, but in 90, 120 days, 60, 6 months out, the numbers came down and worked where we could say yes to it now. All right. You are seeing a lot of newly originated owner finance notes out there that just are structured horribly. Like I said before, people just don't know how to structure them. Okay. It just is what it is. Not every deal is the same. And some people, they get the idea of originating owner finance. That's a great idea because they took some class from somebody else, but that class doesn't show you got to have them for 6 months. You got to structure them properly. You need a right credit score. You got to hold on for some payments. You need to put it with a third-party servicer. So you got to understand the due diligence process of what we're talking about. And not every, like I don't like rural areas for the most part. I like something being a major city for the most part. Okay. Like I said, guys, if you want more specific answers, feel free to go to noteweekend.com and register so you can get the replays if you can't join us, or if you want to join live on here and see what we're talking about on our slides, go to noteweekend.com, join us on the Zoom, and we'll get rock and rolling for you. Okay. Or you can go over to the YouTube channel. We are streaming the Zoom to YouTube directly. Okay. So there is a big thing when it comes to being a successful note investor. You got to have a little bit different mindset. Many real estate investors, and I say this as a real estate investor, when I first got in the note business, I came in from the traditional real estate side versus the note or banker's mindset, right? I wanted to, if I'm going to buy something, I'm going to fix and flip it. I'm going to fix it up and flip it. That was one of the biggest things. That's literally one of the biggest mistakes I made my first 2 years as a note investor. First 2 years as a note investor, I was basically buying notes, non-performing notes at discounts, and then foreclosing, working to foreclose. I wasn't willing to do a loan mod with anybody. I lost a lot of money. I would have made a whole lot more money if still buying those deals, but then I worked out with the homeowners. I probably could have modified probably, half of them at least for cash flow and not had to do any work. Because if you're going to foreclose, not only are you paying holding costs, your money costs, but attorney fees, servicing fees to get something, then you're going to rehab the property after a while. If you're modifying loans and keeping people in their houses, you can get cash flow coming into you almost immediately, which is a good thing, right? You got to realize that as a note investor, if you're buying the note, you don't own the property. You own the debt. You're the bank. So I don't chase equity deals. That's one big thing that people get excited about. Oh, there's equity. There's equity. Well, if you're buying the property, okay, great. But you don't own the property. If you're buying the note, you only do what's owed on the note. If there's 50 grand, 100 grand above your note, you don't own that. The only way you would get that is if you took it to foreclosure and nobody bid at auction, or you're able to do a deed in lieu for the borrower. But borrowers know if they have equity, they will fight you for equity. Like there's a deal that came across my desk this week alone here in Austin, Texas, on a property out in Steiner Ranch, which is a nice part of North Austin. The house is worth $2.5 million. Borrower hasn't paid in 90 days. The note balance on it is $900,000. I could buy that note for 80 cents on the dollar right now. So I could pay $720,000 for about a $950,000 note. Some people get excited about that. Oh, it's on a $2.5 million property. Well, no, I can only collect on that debt. Well, a 200 grand is pretty good, but that borrower knows they got that equity. They got $1.5 million in equity. Of course, if somebody ends on a $2 million house, a little bit more sophisticated than most people, they're not, this isn't going to go to foreclosure. They're going to hire an attorney to delay. Okay. What you have to realize is that's why I don't chase equity. If people know they have equity, they'll fight you. It's not friendly. This is why I like buying notes that are over encumbering the property. They owe more than the property's worth. I buy that note at a big discount. The borrower has no incentive to fight you in a lot of cases, and they'll work with you to do a deed in lieu or cash for keys in some cases. All right, let's see here. But that's the thing. I see people come in that there's like the house is worth 200, the mortgage is 150. They bid 150. I'm like, why are you bidding 150? There's no way for you to make any money. If you take it to foreclosure auction, you can only bid the legal balance is 150. That's all you're going to get. Yeah, it's not worth the risk to me in a lot of cases to try to chase that. Okay, and here's the thing too. So many people, we come from a matter, and this is we do this to ourselves at local real estate clubs. We learn a different tool for the tool belt, right? I'm going to learn this month about some different strategy. I'm going to learn a new strategy, so I'm ready for anything. Well, that's being a jack of all trades is a master of none. And I always tell people like focus, niche down what you're focused on to maybe one or two real estate strategies. And the same thing in the note investing side, focus on your buy box. Like my buy box is primarily what we buy is single family homes. That's on the residential. Commercial is a little bit different, but that's on residential, which is where everybody should start off at. Single family homes between $50,000 to $400,000. You're probably gonna get the bigger bang for your buck at $250 or less. Okay, but I'll look at $405. There's some places I'll go up to $1 million. But for the most part, $50,000 to $250. First liens, owner occupied properties. To do more exit strategies. Okay, and starting off 5 states. The 5 states I would start off if I was brand new would be Ohio, Michigan, Indiana, North Carolina, South Carolina. Those would be like the 5 states I would start off with. And that's a mixture of judicial and non-judicial states, right? Why not Texas? Well, Texas is great, but Texas is overpriced in a lot of cases. You don't see as much inventory here. What about Vegas? Well, yeah, Vegas is not bad, but you don't see a lot of stuff there all the time. Why? Because people are modifying. Banks are modifying. If you do see something there, great, jump on it. I mean, I got a tape in a 284 notes that had stuff in California and Texas and Indiana and my favorite states, and I'm bidding on some of this stuff come Tuesday. But I got to go through a lot of them, and I immediately get rid of a lot of stuff that I don't want. Like I don't focus on, if anything's got a small balance like under 25 grand, I'm gonna get rid of it. If it's valued below 25,000 or really below 40,000, I'm probably gonna get rid of it because it's probably a piece of shit right now. Okay, so note investing, there's a lot that you'll come across and you'll be, oh, But there's also why I don't focus on owner finance notes, because I don't want to send all this mail out to people that have a note and they can't afford to take a discount. It's not worth my time. I'd rather deal with the banks, or once I make the right contact through LinkedIn or an email blast, they send me lists on a monthly to quarterly basis. I just got to follow up with them on a monthly basis. Okay. And you got to learn to avoid the shiny object syndrome. I get it. Oh, it's great. I'm going to buy these foreclosures. I'm going to fix them up and I'm going to sell them on owner financing and sell them out. Not going to happen. It doesn't work that way, just like it is. Okay. Well, I'm going to go do this and this and this, and I'm going to do this. I'm a steak and potato kind of guy, pretty vanilla when it comes to it. The more outside the craziness deals that you do, the less effective you're going to be. You want to be systems, more unique things you can't systematize that. Hey, Joy Young. Yeah, it's different. It's not as everything out there. All right. You got to understand. And there are some people, don't get me wrong, I'm going to tell you right now, I buy non-performing notes. That's my bag, baby. Buying non-performing notes. That's what I focus on. Yes, I buy performing. Anybody can buy performing. A monkey can buy performing notes. Okay. But you have to realize that when it comes to note investing, you have to understand non-performing, because your performing notes at some point, especially with everything going on in the market right now, people can't pay their grocery bills, their utility bills, their credit card debt, their auto loans, all this stuff that people can't afford. The economy is not great, at least, just put it that way. Most amount of consumer debt we've ever had. Okay. For anybody, if you're listening to everybody saying, oh, it's so great, the job market's great, bullshit, it isn't. Okay. Job market's great. No, it's not. Stock market's great. Is it really? When there's only like 4 or 5 companies in the black and the rest are all like red? It's not. Do not let the talking heads on both parties lull you to sleep. Okay. One side's worse than the rest, but we'll leave that for a different live stream of some sort. Focus on assets. And that's what I like so much about buying notes, is if it's a 6% or 7% or 8% note, that interest rate's not changing. If I'm buying at a discount, I'm almost immediately making a double-digit return. We actually make more money most of the time by keeping people in their houses. I don't want to own property. I want to own debt. As I said earlier, cash flow should be a number one priority, not just equity, not just property. You got to have cash flow. You got to be making money. All right. Thank you, Joy. Thank you, Gerald. Thanks, everybody out there. Taking back real estate and doing fix or flips are secondary. Now, you got to be prepared for that. So when I'm evaluating a note, a non-performing note, my first strategy is, what will it be like if I can get them back on track? Okay. If I have to take it back, I got to make sure that foreclosure is going to be a positive thing. And I also got to look at days on market. It doesn't make sense if you can buy a note cheap and they're not going to pay, and the days on market are beyond like 6 months. I had a guy one time reach out to me. He's buying a note in Texas. He's all excited about Texas. He's out in LaGrange, ZZ Top Land, as I like to joke. And the house was valued at 100. They owed about $130,000 on the debt. They hadn't paid in over a year. And I asked him, I said, okay, what are you buying the note for? He said, oh, I'm buying it like $35,000. I'm like, okay, so you're buying it at 35% of value. How much work does it need? Oh, it needs about $40,000 work. I'm like, ooh. I said, okay, you can foreclose quickly on it, but you're going to be into it at $75,000 when you figure what you're buying for the note and the rehab rough. He goes, yeah. I go, what's the days on market? He goes, 365 days. I'm like, oh, no, that's not a good deal. It's going to take you a year to sell that house on the average days on market. I said, your holding costs. He goes, oh, yeah, I got a lender who's going to lend to me money at 15%. I'm like, that's not good, dude. I mean, that's a hard money cost. You're going to lose money on that deal. Doesn't make sense. So you got to know your numbers. That's one thing you'll see me harvest on, especially if you see me go through some of the tapes on my YouTube channel, going through and understanding some of these things, and we'll talk about the difference between a deal and a dud on here later on. But no, there's things that will kill your deal, and I told them, I said, listen, you can go back and cancel the, you just found out days in market is a year. That's a deal killer. Cancel it. Okay. Or like if sellers, like they had the seller tell me a deal, it was like, oh, they're, what were they doing? It was a bar wants to modify. Okay, wants to modify. Have they modified? No. Well, then why are you selling it at a performing? Well, because they'll be re-performing in 2 months. I'm like, but they haven't yet. They haven't performed yet. So I'm not going to buy it for, they're going to perform, because their last 12 months show they're not performing. If they pay on time for 6 months, guess what? Or they bring a big chunk to the table, then I would buy that. But a lot of people, you got to understand, there's a lot of things. You're doing due diligence, not only in the property, but the borrower and the collateral file. And it's okay. Don't worry about it. You'll learn it. It's a process. It's not, oh my gosh, it should be overwhelming. You'll learn more from doing your first deal or taking a 3-day class, and you'll learn everything else. You'll probably learn more about note investing in this note weekend, in this 3-hour class, roughly 3.5 hour class, than most people will teach you out there as well. All right. So let's get into our session number 3 here and talk about note sellers. Okay. How are we doing on time before we need to take a little break? Oh, we're doing good. Okay. Where do you find these deals, right? How do you find notes? Okay. Well, Joy, make sure you register at noteweekend.com or book a call with me at talkwithscottcarson.com if you're at your live streaming. Okay. But note sellers, there's a variety of different ways. Now, ways to find note sellers is we go direct to banks. We'll talk about what we say or who we contact at banks, different lending institutions. There's some mortgage companies out there, or real estate funds, stuff like that are in the note space. Mortgage bankers, not mortgage brokers, mortgage bankers. Mortgage brokers originate notes for lenders and stuff like that, but they don't actually hold the assets. Mortgage bankers will originate the loans off a line of credit, or they'll hold those loans on their portfolio. Okay. You can also buy notes or find notes by contacting servicing companies. Okay. Some servicing companies have a trading platform where we'll sell notes on behalf of their clients. Now, you're not going to call like Ocwen or SPS. I want to buy notes. They're not going to do it. There are some servicing companies. Don't call the 1-800 number. Okay. They're not going to know what the hell to do. You got to really kind of go up the chain of command, and I'll share with that either. You can go to note conferences or different note conventions that are out there. Like I like to go to the Mortgage Bankers Association or the West Coast Western Servicing Companies. You can find note sellers there, people that have job titles like the capital markets or special servicing. But if you've got a LinkedIn profile, guess what? You can literally log on to LinkedIn right now and find note sellers. Type in note sellers. Note investors is one thing that you can do that's free. Or you can type in the 4 or 5 job categories that have it. Somebody asked me a question, what about companies like Mr. Cooper or Shell Point Mortgage? Mr. Cooper, one of the bigger servicers, I've never had any luck with them. Now, if you can find out who the lender is that Mr. Cooper is servicing the loan for and contact that lender directly, you might have some luck. But we'll talk about that in just a second. Okay. Shell Point Mortgage, I don't know. You have to contact their special assets or secondary marketing manager. Private sellers like me, other note investors have notes available for sale, things like that. I also will track the county recorder, the county clerk. You could go to your local county recorder's office or county clerk and search for assignments. Assignment of mortgage. This is what happens. It's when a note is sold, it's not a deed that transfers. Yeah, in a contract for a deed, it's a deed is transferred in. But in a traditional mortgage, if you go into your county recorder, county clerk, and look for assignments, you'll see a list of all these mortgages that have been assigned from one bank or one lender to another one. So if I buy a note from a note seller, there will be an assignment of mortgage from their company to my company. Now, if I sell a note to somebody, I have to go create an assignment of mortgage. It's pretty simple. That goes from my company that assigns it to them. So you can search. We track like assignments at like Harris County, which is Houston, one of the biggest counties in the country, often has the most foreclosures too. And then also like Orange County, not Orange County, California, but like Orange County, Orlando in Florida too. We check there's like, somewhere around like 10 to 14,000 assignments every year there. But what you do is we consolidate that list through like our title companies to find out the major players, like the 4,000 true entities. And then we'll start contacting the LLCs or smaller institutions up there to buy their note to get on their list. Okay. Oh, there you go. Joy's in Harris County. That's Texas. Now, another thing you can look at too is foreclosure lists. Okay. we all know foreclosure lists are non-performing notes, right? Because they're going to foreclosure auction. Well, when you buy a foreclosure list, like in Texas, we use the Roddy list, or four and the number four closure.info. Just Google Roddy, George Roddy. So there's like, let's see here, there's like 400 foreclosures going to auction on Tuesday. And you can buy that foreclosure list from Roddy for about 70, 75, 85 bucks. Well, it's a spreadsheet. Well, what I do with that spreadsheet is I'll get rid of like the Bank of America's, the Chases, the Cities, the Wells Fargo's. So where I have smaller institutions or private sellers on there. And then I'll either call that bank directly and ask to speak to their special assets or secondary marketing manager or their chief credit risk officer. Or if I can't find a number for them, I'll call the actual attorney and talk to the attorneys and say, hey, I know that you're foreclosing on this asset. Would you be able to put me in touch with the bank? I'm interested in buying the note and having you retain as counsel. Now, you're not going to have that happen before Tuesday, especially because Tuesday here in Texas is Super Tuesday, so everything's going to foreclosure. But what I like to do is I'll take that asset and that property that's going to foreclosure. I don't use it. I'm not chasing that asset. I'm chasing that bank or that contact. So I get their list of stuff all across the country. I can get their list of non-performing notes all across the state or wherever they have. I've even found private lenders that way who are foreclosing on a note in their IRA and contact their attorney who's put me in contact with the lender or the investor, and it's become a private investor for me in raising capital. So I like using the foreclosure list. I'll dollar for dollars occasionally, or I'll find that bank and jump on over to LinkedIn and look on there for you. Okay. If you go to my YouTube channel and search for the Finding Note Deals or Finding Deals webinar, it's an hour and a half long video of me just showing you the different ways of finding note deals. Okay. Now, the different departments at banks, this is your bigger banks or medium-sized banks. There's basically 4 to 5 names that you want to search for. And you can do this by just doing a search on LinkedIn. Okay. Your biggest institutions, your biggest banks, they have a department called the Special Assets Department. Okay. The Special Assets Department, if you search for that on LinkedIn, you'll find people and, find individual people and call them. Or if you have the main corporate number for a bank or lending institution, call them and ask to speak to their Special Assets Department or Special Assets Manager. Okay. A lot of banks in REITs, real estate investment trusts, stuff like that. Some hedge funds will have what's called a secondary marketing department. That may be also named. Some banks will also have a secondary marketing department as well. So that's another job title. Call the main corporate office. Can I speak to somebody in charge of special assets or your secondary marketing department manager? These are the people that handle the note sales. Big, like insurance companies, large REITs, Wall Street firms will often have what's called a whole loan sales department. Well, they're selling off portfolios. Now, oftentimes you can cherry pick those portfolios. Like Flagstar Bank is selling off a portfolio of 285 notes. I can cherry pick. Cherry pick, it means I can pick individual assets off. I don't have to buy the full 285. Okay. Now, if you're buying from Bank of America, Chase, Citi, Wells Fargo, they want you to buy 50 to 100 million. You're not going to buy from those big 5 or 10 banks. That's okay. There's plenty of smaller institutions, lenders out there as well. And speaking of smaller banks, I wouldn't contact banks that have like one branch, okay? Because they're just too small, okay? They're too small. They can't take too big of a discount. But banks that have like 5 branches or more, you can reach out to them and talk to them at their chief, ask to speak to their chief credit risk officer. That's a good spot to go to, good person to reach out to. Sometimes they'll sell some stuff for you, or if they won't sell you the note, they may take your bid and hold it in case they don't sell the foreclosure auction. That's happened as well too for you out there. Okay. There's some resources for you that can help you find these different departments and numbers or emails. Besides LinkedIn, laneguide.com. That's laneguide.com. You can go to bowerfinancial.com. Actually can pull a list for you of banks that have troubled assets. Won't give you emails to them, but they'll give you the name of the president, and you at least see the ratios. We'll like to pull a quarterly report from Bauer Financial because every bank has to report to the FDIC on a quarterly basis. So they send over their information. Bauer Financial consolidates that. So like for me, I will call Bauer Financial, say, hey, send me a list of the quarterly reports of banks that have 5 branches or greater. And that might be 1,500 to 2,000 banks. And I can literally see, okay, who's got good ratios, who's got the most amount of debt. It's about bad debt over 90 days. Who much got stuff coming down the pipeline is 30 to 89 days late. And then it gives you like the main one, the customer service number. Well, I don't worry about the customer service. I'll jump over to LinkedIn or I'll call the main corporate office number. FDIC.gov. You can go there and look for banks that have gone out of business and look at reports directly. You can contact your local like savings and mortgage lending licensing department in the state. Like here in Texas, it's the Texas Savings and Mortgage Lending. I can go in there and request a list of every licensed mortgage broker, mortgage banker, and servicing company doing business in Texas. They'll send me that information. Well, guess what? Not only does it give me names of the company, but names of the individuals and emails and phone numbers that I can contact directly. That's a good email list. And then if you're not just in Texas, you're in other places, every state's a little bit different. Like Texas, Texas is Texas Department of Savings and Mortgage Lending, like California is the Department of Real Estate. Some states is the Department of Insurance. So you just have to check out who handles your mortgage bankers or mortgage brokers licensing department. Now, some states will just send you to the National Mortgage Loan Originating Service or MLS website, and that's hard to search on there. That's not worth doing it. Okay. Scotsman Guide is another resource I use. That's Scott with one T, scotsmanguide.com. And I look on there for commercial lenders or portfolio lenders that originate notes and holding stuff as a great way to find potential deals. Okay. There are some platforms out there like paperstack.com. Watermark Exchange is kind of old. My buddy Val is good that runs that. He may have a few notes on there, but it's not like it used to be back in the day. SN Servicing has a loan trading platform where you can go on, register, and then one of their traders will send you lists on a pretty regular basis. Deb Expert, not debt, but like DEB, expert.com. You can look at notes on there. Fixednotes.com has some stuff on there. It's kind of junk for the most part. If you're looking for commercial, 10x or auction.com is a place to find commercial notes, commercial auctions. Mission Capital Advisors or DebtX are two of the bigger guys that the big banks use, and it costs you money to register for those guys. Note Trader Exchange, you look on there, or even like exchange.loans as well. All right, good stuff. All right, let's do this. Let's take a quick little 5-minute break, bio break for you guys to go get rocking and rolling, and be right back. Okay. All right, let's go through the different types of note scripts, what to say, what not to say when you're reaching out to these banks and asset managers to find deals. All right. It's important because you can say the wrong thing to bank asset managers or note sellers, and they can smell that you're brand new. That's okay. We all got to learn. All right. Yes, you'll still talk to people. Yes, you can still pick up the phone and dial for dollars. Okay. We'll still do that occasionally. I'll still call asset managers, bank asset managers. I don't do it as much as I used to. When I first started off, I was dialing 50 to 100 phone calls 3 to 4 days a week. At the end of, I was like, hoping that I'd have like 100 direct connections. Well, at the end of like 60 days, I had 1,000 direct connections. All right. Because I would call and follow up. Here's the most important thing you have to realize when you're looking to buy notes, ladies and gentlemen, is that it's all in the follow-up. Everything is in the follow-up here, whether it's a LinkedIn email message, email blast once a month, follow up with a phone call, text messaging. You just got to follow up with people. All right. One of the most important things you can do is follow up with everybody, because people are just busy. They, 10 minutes you get off the phone with them, they're thinking about something else. They're not thinking. If you call them, and that works in your favor. If you call and you screw up a phone call, just hang up and call them back the next day. Okay. You're going to have a basic elevator pitch when you get a hold of the right person. And it's the same thing, like a basic message I leave on a voicemail, like, hi, my name is Scott Carson. I believe you're the person in charge of your bank's special assets or non-performing note sales on either the residential or commercial side. I've been a note buyer for 20 years. Would love to talk with you about, see what you have in your books that you're looking to get rid of. We're buying, residential loans under $1 million. And then we're also buying small balance commercial notes from 250 to 5 million. Okay. That's your basic. What do you have in your books you're looking to get? Are you the right person to handle note sales? Yes. Great. What do you have in your books that you're looking to move this quarter? Every bank's got stuff they're looking to sell. I'm looking to buy for my own portfolio. Don't tell them you're brokering. Don't say you're broker. Okay. They don't need brokers. Okay. Quit being a broker because all you're going to be is broker. Okay. Not richer. Buying for your own portfolio. Yes, you may still be wholesaling. You may still be flipping these notes, but you're still buying for your own portfolio. You say you're flipping or wholesaling, they will blacklist you. You do not want this. Okay. I'm looking for I'm looking for something with some hair on it. It means it's non-performing for a while. Okay. We're looking to work it out with the homeowners or the borrowers. If we can do that, we'll try to do that. Some banks like to hear that. Others don't give a rat's ass. Okay. How soon can you get off my portfolio? I'm looking for residential loans under $500,000 in balance in most of the major markets. Okay. I would not go in there and just say like, oh, I'm looking for stuff in Texas or I'm looking for stuff in Florida. Okay, that's great. Just say I'm buying in most major markets. The whole idea is to make it as simple for the asset manager to just send you the list, to download the spreadsheet and send it to you. Okay. You start saying, I'm only buying the 78750 zip code of Austin. They're not going to send you anything because they're not going to take the time to filter through it. That's not their job. Get the tape, you filter through it. Okay. Do not say this. Okay. I have 20 million a month to buy. That sounds like a joker broker. I'm looking for notes and REOs. Don't say that. You're looking just for notes. If you say REOs when you're calling around, they're just sending you to the foreclosure department and you're just going to go into a voicemail box that nobody checks. Oh, it says call the realtor. Okay. I'm looking to broker or wholesale. If you say that, you're just wasting time. And they can tell it. You got to practice this a little bit. Don't say I represent a buyer. I'm a buyer's rep, buyer's mandate. I just threw up in my mouth. Okay. Somebody tells me they're a buyer rep. I mean, I know they're a joker broker immediately. Okay. I'm looking for anything. Send me your first, seconds. No, you don't want anything. That's another sign that you're a joker broker. Okay. I'm looking for first liens. I'm looking for small balance commercial. Okay. Don't say specific things. I'm looking for all this stuff only Texas. Get the list. Listen to me on this. I still get people to this day that screw this up because they think they know better. You don't know better. All right. You don't know better. But banks will send you if you sound like what you're doing. Hey, I buy them from my own portfolio. Do you have anything in your books you're looking to get rid of this quarter? Either small balance commercial or some residential notes that you don't want to foreclose on? Okay. You can say you're looking for second position liens, but I would not waste your time chasing second position liens. I'm sorry, Sylvia. Seconds are a waste of time. Seconds are way overpriced, and there's a lot smaller aspect. Okay. Now, a lot of people chase second liens because they think they're going to buy them a whole lot cheaper. That's not the case like it used to be. Years ago, you used to be able to buy them for 5 and 10 cents of the balance. That's not the case anymore. Another reason people chase second liens is because, like, oh, I only have a small amount of money. You know what? I don't care if you have a small amount of money. Go market for capital. I think you live in Florida. There's a lot of capital in Florida that people will use. Okay. Or will lend you to buy. Buying in a first lien position is actually in a better position, a more secure, safer position, and bigger checks. Okay. Seconds, you got a whole lot more extra due diligence. You don't necessarily own the property. There's a lot less of those out there. A lot of these major banks that have notes for sale aren't selling seconds because they're not dealing with seconds in a lot of cases. Okay. A lot fewer seconds out there. You're going to be much more frustrated going after second liens. Just the way it is. I can either blow smoke up your tail pipe. I don't want to do that. Okay. Just don't see. I get so many second lien investors reaching out. Do you have any seconds? Do you have any seconds? No, I don't have any seconds because they're just not out there. They just don't originate as many anymore. Okay. You want to fight over scraps? Go fight over scraps. Okay. I'd rather deal where I've got more portfolio, more opportunities to make things happen. Sorry, that's just the way it is. You may not like me, and that's fine. No offense. You're gonna be better off if you listen to me on the first lien side. Now, the best times if you get an email list or you pull a list from like the Texas Savings and Mortgage Lane Department or some other laneguide.com, you have a list. You don't want to email any weird times. There's specific times that are best to email bankers. Okay, asset managers. Tuesday, Wednesday, Thursday. Don't email them on a Friday. Don't email them on a Monday. Okay, Friday, they're not going to look at it. It's going to be buried by the time they get around to it on Monday or Tuesday. All right, Monday, they're too busy doing other things, meetings and stuff like that. So best time to contact them is Tuesday, Wednesday, Thursday. And I would send your email between 10 and 3. their time. All right. If you have a listener all across the country, then shoot for noon. That's going to be either 10 a.m. on the West Coast or 1 o'clock on the East Coast if you're in like Austin, Texas. Okay. But email them. And the first time you send an email, you'll probably see a 10 to 20% open rate the first time. That's normal, very normal to get a 10 to 20% open rate the first time. Don't be disappointed by that. It's all in the follow-up, okay? Also, make sure you've got an email address. Send from like a true customer relationship management software like Keep or Active Rain or something like that. Not Active Rain, I'm sorry, MailChimp. And use a professional email. Don't send it says tigerlily105@yahoo.com or AOL.com or gmail.com. Or don't use your business like I don't use info@Scott Carson. That doesn't look good. It's got to come from Scott at We Close Notes. Okay. Something professional. And you probably need a website, guys. Bankers are going to look at your website. If you don't have a website, they're going to go to LinkedIn. If you don't have either of those, guess what? You don't look like a note investor. Once you send that first email, you're going to send the same exact email again to those that didn't open it the first time. And you're going to see a 5 to 8% open rate about the second time. And guess what? You're going to send an email 48 hours. If you send it on a Tuesday, the first one, send your second email on a Thursday. Same thing. You can send it a third time to the people that still didn't open it. Same exact email. And you'll see a 1 to 4% open rate the third time. Now, if you add those up, you got about a 30% open rate. That's a pretty good start. And next month, you do the same thing. So this is your 30% is your hot list. And then the other 70% of those that haven't opened, you still email them twice at least a month to build a list. Some people look at their emails. Some people don't. It's repetition. You can't really expect to send one email and everybody fall over with their spreadsheets up in the air for you to pick. Okay. Some are better marketers than us. And the whole idea is just this drip marketing monthly campaign pays off because not everybody has something every month, but they will have something. Okay. That's what I'm saying. Send it at 48 hours. If you send one in the morning, send one in the afternoon, the next one. Send it in the afternoon, send the next one in the morning. Do not send it in the middle of the night. Do not send it on a Sunday night. Okay. People do that all the time because they're cheap. Oh, I just have to send it through my Gmail account. No, go get you a CRM, pay for it so you can schedule it to go out. Well, I got to work. We'll go pay the money to schedule it for it to go out at the appropriate time. It's worth it. Guys, this is professional. You're dealing with bankers, asset managers. You got to pass that smell test. If you try to do everything cheap, you're going to look cheap, and you're not going to get any deals. Okay. 80% of sales comes after the fifth contact. It's just the law of nature. Okay. That's why they tell you, oh, you got to send multiple times a mailing list. Well, that's great, but I don't want to spend $1 per piece of mail piece. I'd rather do this, which doesn't really cost me anything. Okay. If you're going to pick up the phone and call bankers, which I still highly recommend you do. Okay. Best time to call is Tuesday, Wednesday, Thursday. Best times, 10 a.m. to noon and then 2 to 5. They'll take a lunch break and they will usually have a longer lunch break. So that's the time. Email and follow up with a phone call. Email your list, give it 24, 48 hours, download the who opened the email, and then call that list. Okay. Expect to leave a lot of messages, but always, always, always leave a voice message so they know you called. You know your elevator pitch, it's less than like 30 seconds, 15 seconds or less, and repeat your phone number twice. If you got an easy email, which you all should get an easy email, Scott@WeCloseNotes.com. Pretty simple. Okay. Some of you have complicated LLC names and you want to be all long. Nah, keep it simple, stupid. Just keep it simple. Okay. Leave your phone number twice, repeat twice. Don't call and then not leave a voice message. You just wasted your time. Always leave a voice message and smile while you dial. I can't tell you, it's so important. It can be, difficult to do sometimes because it's like the 8,000-pound phone here. Call 2-3 hours at a time. Don't make 10 phone calls and stop doing it. Call. And I expect if you make 50 phone calls, you'll probably talk with 14 to 15 individuals. You'll probably end up signing 4 NDAs, and you'll probably get 1 tape. And that tape could be either 1 note or could be 1,000 notes. It just varies on how you call. But the law of averages, that's about the law of averages on the thousands and thousands and thousands of phone calls we make. And I track my phone calls by just a spreadsheet. Who did I call? What time? What number did I call? Did they leave it? Did I get an email address? Then I follow up with an email to them at the end of the day. Okay. 50 phone calls. You can do that in 2 to 3 hours because you're dialing for dollars in a lot of cases. But that's the thing, ladies and gentlemen. If you've got a cell phone and internet, you can do this business from anywhere. It's a whole lot cheaper than mailing out 5,000 postcards that you get a 1 to 4% response rate on, and it's one time. You got to do that every month. Well, I'd rather send an email blast, make contact with an asset manager who's going to send me their tape every month or every week. Okay, so 5-minute, 10-minute phone call or an email 5 times or 10 times to get a list is well worth it. You see the return on time? That's also why I don't chase owner finance notes, because I got to mail out letters. They call me, kick the tires, not worth my time. Let's get one bank or an asset manager that send me their list of stuff every month at bigger discounts, bigger yields. Whoop, whoop. It makes much more sense to me on that. Follow up. I cannot agree to that enough. Send an email, make a phone call, connect with them on LinkedIn. Send them I don't want to send them any direct mail unless you actually do get their physical address. Sometimes sending a note's good, but just rinse and repeat. 80% of sales are made up to the 5th contact. And when you're making phone calls, track who did you talk to? That's your hot list. Who didn't you leave a message to? That's the one you follow up with. So like the best thing I would do is like start off with a list of 50. If you get through like the first day where you leave messages on like 25, okay, and you talk to 25, well, guess what? The next day you call, or if you call 2 days later, don't call the 25 you already spoke to, call the 25 you left messages, and then bring on another 25 new people. The 25 you've already talked to, you should have either gotten an email or found out a number or followed up with them, like the LinkedIn. I can just follow up with you monthly just to touch base with you, or once a quarter, so I don't bother you. They'll almost all of them will say, yeah, here's my email address. You can just drop me an email. That's fine. Perfect. Or if don't call me anymore. Okay, fine. We'll call you. Remove you from my list. There's plenty of fish in the sea. Okay. We've got a 4-hour video. Yes, a 4-hour video of me making phone calls. If you go to my website or go to LinkedIn, go to YouTube and click on that link or go to that link, calling asset managers. 4 5-hour me making phone calls. You hear the conversations, you hear the back and forth, you see exactly what I'm doing. It's valuable for you. Okay. No buying for dummies. That's our 3-day class. That's really going to help you more of the nuts and bolts, more of exactly. We spent a full day on the finding side of pulling these different lists, showing how to find the asset managers, what to say on LinkedIn, what not to say. It gives you a 200-page manual with contracts and sample images so you can plug and play this into your business as well. Normally, it's $9.97. We're running a sale for 50% off if you use the code weekend. Okay. That's our main nuts and bolts class for you. We also have a monthly membership. If you want to spread your learning costs over the year, you can sign up for our membership. It's $97 a month. Just go to noteumbrella.com. Pretty easy. That's going to give you access to not only our classes, but also our weekly coaching calls, tapes, and a whole variety of other stuff for you. Noteumbrella.com for that. Okay. Let's dive into session number 5, markets and pricing. Feel free to ask questions, guys, but keep your questions on track. I know I go through a lot of this stuff pretty fast, but there's so much resources out there that we've provided for you. Not only the podcast, but also our YouTube channel, the shorts. We do a lot of stuff to really help make sure that you guys understand this is feasible. You can do that. You can do this. Okay. This is just the first step in your note journey. Okay. I want to give you as much tools as possible. And, this is a great place to get started for you. So let's dive into the markets and pricing side. So market expectations here. And your markets can vary on a variety of things, ladies and gentlemen. Okay. On the popularity of the market. It's more popular to buy in Austin, Texas than Austin, Minnesota. Okay. Market values. versus like me buying here in Austin, Texas, with an average home price is about 500, 400,000 versus like down in Ingleside, Texas, where it's under 100,000. Okay. Foreclosure timeframes vary fast here in Texas to long in New York and everywhere else in between. Okay. Population, that varies as well. If you high populated area, more product. Aransas past Texas with 3,000 people or less. I would probably avoid that for most of you unless you're familiar with that. The idea is just to initially start buying in areas. I'd say 50,000 people or greater. Gives you plenty of flexibility, plenty of realtors, rehab crews, buyers. Okay. If you're buying in smaller rural areas, it's a much longer days in market, less buyers, more difficult to get to. It'll cost you more. Just because it sounds like a good deal doesn't mean it is based on the market. That's why I say avoid rural. Rural have issues. Now, some people are like, oh, I want to buy mobile homes on an acre of land. Okay, there's nothing wrong with that. But just expect if it's more rural, it's going to, your days on market will often take longer. Now, we've got a buddy of mine he's Josh, the friendly bearded realtor. He goes around and takes all these videos of these lands, 5 to 10 to 20 acre parcels he's selling. They're all rural. That's his niche. That's his bag. It totally works fine for him. He's all over Texas. Me, for you guys, you want to stay in populated areas. Okay. That's one of the most important things. Makes it easier for vendors, makes it all, if you end up having to sell that asset or rehab it, you put plenty of people there for you. And then, of course, inventory. Like I said, some areas are really attractive, but you don't see a lot of inventory. Like I have somebody, so I want to buy in San Diego. I'm like, well, good luck with that. What do you mean? It's one of the most hottest areas and people are overpaying for stuff. You're not going to see a lot of discounted stuff there. For what you can buy one in San Diego, you can buy a whole block in Kansas City or Ohio, So here's what's hot. And I mean by hot, it's the most expensive note markets. Okay. California, Arizona, Texas, Nevada. You really have Reno and Las Vegas. You can still find some stuff. Nevada's been cooling off. Phoenix has seen more inventory than what we've seen before in the past. Georgia is always hot because it's 30 days to foreclose there, just like it's hot here in Texas. Although we are seeing a little bit more product in Texas, primarily Houston and Dallas. Those are the two bigger markets, and this we're seeing more foreclosures. Georgia, seeing a few more in the Bulldog state or the Peach state, sorry. And then I don't see a lot of stuff in Oregon, Washington. I mean, I wouldn't want to buy there anyway, but those are the most expensive note markets. Okay. Rami has a question. How long do you usually hold on to the note? Okay, so this varies. So I'm going to take it. If I can get that note performing cash flow wise, I'm going to hold on to it for 12 to 24 months, sometimes 36 months of on-time payments for cash flow. It all depends on the return on investment. What kind of return am I getting? Okay. Now, if it's a foreclosure where I have to foreclose, I'm going to foreclose, and I'm usually going to then either turn around and sell it, fix it up, and go from there. So it depends on times of markets. From our foreclosure stuff that we foreclose is probably going to be on average 12 months. If you figure it takes 6 months to foreclose and then 6 months to rehab and sell it in a lot of cases. So this is short term, 12 to 36 months. Okay. I never tell our investors, oh, we'll do it less than 12 months. That's a bad thing. Okay. Under promise and over deliver. Now, if we say we're going to do, we're borrowing somebody's funds for 36 months, but we sell the deal off in 12, we'll give them their money back plus return. Okay. Does that make sense for you, Rami? If a note's returning you 20% or 16% and you're happy, you hold it on as long as you want till they pay you off. Okay. You are wrong, Sylvia. When I started off, and I respect to saying this, hey, I only got 100 grand. That's great. With zero experience, I'm a new investor with zero experience. I don't think it's wise to raise capital in my position. What advice do you have for me? Well, go raise capital. That's what I would tell you. If you only use the 100 that you have, well, what happens when you've put that 100 grand to work? You're waiting around for your notes to sell off. Notes aren't not going to be like a 30, 60, 90-day kind of thing. So now you invest your 100K into one or two notes. You're sitting there for 12, 24, 36 months, not doing anything. Sylvia, what do you do? What's been your 9 to 5 or what's been your career path? What have you done before? You're a deputy. Okay. Did you have experience before you became a deputy? So, so you wouldn't arrest anybody unless you had experience arresting people beforehand? No, you had somebody to hold your hand, but you're laughing about it. It's the same thing. If you're a realtor, are you going to wait to become a realtor until you sold property? No, you can experience while you do this. Here's the beautiful thing about raising capital. It's not about you. You think it's about you because you have no experience, but honestly, it's not about you. And that's the beautiful thing about note. Now, if you're rehabbing property, trying to do it all yourself, yeah. What experience have you had? Have you painted stuff? Can you rehab? Can you fix and flip? We ain't doing that. We, as note investors, as long as the deals make sense, the numbers make sense, you need to know that. But you're not servicing the loan. You have a third-party servicer who's done it for thousands and thousands of deals. Two, if you got to foreclose, you got attorneys who've done thousands and thousands and thousands of foreclosures. You're going to sell the property, you hire a realtor who's sold hundreds and hundreds of stuff like that. This is why it's so valuable. If the numbers make sense in the cash flow, if somebody's got money sitting on a sideline, here's the thing I realize. If they got some money sitting in an IRA or checking or savings account or certificate of disappointment, it's making not very much money. Can we agree to that, right? If you could go and say, hey, I can give you a 10% return for a short period of time of 24 to 36 months, and you're investing in a note that's at 70% of value or less, and you're going to be able to give them an 8 to 12% return, and you're going to be able to put 8 to 12% in your pocket, and it's not you having to do all the work. You get what I'm saying? And if you live in Florida, Broward County, you can very easily find IRA investors. I'll get to that in a few minutes. You can go network at the local real estate club. You can go and the only direct mail we do is sending out to IRA investors. Most of the stuff we automate. So you have to take that off. If it's a good deal, it makes sense. You also have a coach. If you've got a deal, I'm always glad to look at it and say, hey, this makes sense. No, it doesn't make sense. Okay. You're welcome. But you're not, I'm so glad you shared it because you're not the only one. I probably talked to 4 people this week alone who had that same mind block. Well, I don't have any money. I can't do it. Well, guess what? Most of the money out there in real estate investment is people not using their own funds. They're using other people's money. And the best thing about note investing is not all on you. You're relying on other people's experience and you're able to draft off that. Yes, you got to go find the deal. You negotiate that. But if the deal makes sense, get them reperforming, great. If it doesn't and you foreclose, that numbers make sense, great. Okay, let's do it. No, it's not 30 years. Use that 100 grand for, you're probably gonna need 5 grand or less for marketing costs, an LLC, one-page landing website, some marketing, like a CRM, and other little due diligence costs along the way, BPOs, O&E, stuff like that. Or use your 100K when it's really the knockout the part where it makes like 15, 20%, and you want that to be for yourself. Or you use that 100K to fund a quick deal, but then refinance it out with other people's money at cheaper rate, and then you get your money back plus profit and go do something else. Go buy more notes. Okay. That's the thing. If you're looking at seconds, that is a kiss of death because to buy seconds, you really need to buy 5. Because what's going to happen in a second lien position? You can't foreclose and own the property. If you foreclose from a second lien position, you got to take over and start paying that first lien. Okay. So with 5 notes, and all the second lien investors out there will tell you this, you need to buy 4 or 5 because 2 will probably hit. 2 to 3, you're going to have to put in a desk drawer and wait till that bar decides to sell the property or refinance. If you're buying at 80, 85 cents the dollar now, it doesn't make any sense to do that. I love you, but it just doesn't. And that's why most of the second lien investors out there are no longer doing second liens. And honestly, Sylvia, I'd love for you to send me an email who you took, because I guarantee if you're dealing with the 3 or 4 people that I know that have bought seconds or talked big about seconds, they're no longer in the second lien space. They're in either first lien space or in traditional real estate now. Okay. Rami, we could go through, we're not going to go through all that. There's plenty of videos out there. I'll talk a little bit kind of what we evaluate. We go much more in depth in analyzation and the parameters in our 3-day class. And that's why I'd highly recommend you get signed up for the 3-day class. But that's also why we get such a big discount for those that are watching our 1-day class here off of our 3-day class. Okay. What's not hot is the least favorite markets right now are New York, New Jersey, Kentucky. Kentucky wants you to have a $500,000 bond if you're buying for yourself, or $1 million bond if you're buying commercial. You just don't see a lot of great deals there anyway. I hate Chicago and Cook County. No offense to anybody. It's just the worst to foreclose in. So corrupt. Just not avoid, unless you live in Chicago and Cook County, don't buy there. Okay. All right. Assets under $30,000 in fair market value. So that's part of it there, Rami. Like I'll get, anytime I get a spreadsheet, I'll get remove stuff like that immediately. Okay. Immediately get rid of them. Okay. Just doesn't make sense to buy in that area. Low balances, low monthly P&I payments below 250. I'll get rid of that as well. I also, most of the time, get rid of high equity note deals for the most part. There's a ton of equity, unless I can buy that first lien at 80 cents or less. And there's that 80% gives me a big enough spread that if I foreclose and still get paid off, I'm going to make 50 grand or greater. Okay. Where's the most inventory now? Ohio, Michigan, Indiana, Illinois. Outside of Cook County, you'll see a lot of stuff in Cook County, but there's other counties around, like the Lake County, DePage counties. They're okay. Missouri, Florida. You got to be careful about Florida. Insurance costs can kill you. The Carolinas, South Carolina, North Carolina. North Carolina is a non-judicial foreclosure state. South Carolina is judicial. Okay. Oh, what did I say there? Small balance. Yeah, sub 5 million. You're seeing a lot of, I mean, you're seeing some big balance commercial, but you guys aren't going to be buying a $20 million apartment complex. Look for the small balance commercial. You'll see a lot of small balance commercial and distress in smaller institutions, even your local banks. Okay. Pricing models. If it's a non-performing note with negative equity, means they owe more than the property's worth. You can kind of use something called the stair step. We'll talk about that in a second. Okay. Non-performing notes where there's equity, most lenders are going to try to get you to pay 80 to 95% off the unpaid balance or the legal balance or payoff. That's what the PO stands for, payoff. That's okay in some states because if there's equity, you're foreclosing, you're going to get a chunk of change. If you're buying that note and they reperform, you got to make sure that reperformance number, and I'll show you how to do that, makes sense for his yield too. Contract for deeds, you're going to be paying on the non-performing side somewhere between 30 and 60% of the lesser amount of the unpaid balance or the fair market value. Okay. Junior liens are overpriced currently due to lack of inventory. I can't tell you that enough. Okay. Commercial is totally going to vary asset by asset, location by location, cash flow just varies on that stuff. Okay. You're going to submit a bid specifically on commercial as a percentage of the unpaid balance, but you're always going to reduce taxes owed. So one part of your due diligence is look at how much in taxes are owed on your property before you make an offer. Okay. And when it comes to the negative equity, this is kind of the stair step model. Now, some people will say you can't use the stair step model. Yes, you can. You have to in a lot of cases. Now, sellers sometimes don't want to give you that, but you use the stair step as a guide to help you out to. Now, especially it comes in very, very importantly on the lower valued assets. Because here's the thing. If the asset is at $30,000 fair market value, you're not going to be paying 70 cents on the dollar for that. That's 21,000. It doesn't leave you any room to really make any money if it's only worth 30, right? 21 for the note. And then you're going to foreclosure costs on top of that. You might make 4 or 5 grand. No, that makes no sense. It's only worth 30 and you got to rehab it. That makes no sense at all. Okay. So the lower value stuff, the lower you price off of fair market value. This is if they owe more than the property is worth. Okay. So if it's worth 30, but they owe 50, you're gonna be making like 25% of the fair market value, $7,500. Okay. That goes up 30s, mid 30s at 40K values, your mid 40, the fair market value, 50s and above, you'll be paying 55, 65 cents on the dollar for a one-off deal. You sometimes get it less. All depends on what's owed, how far behind they are, to where it's at, how motivated the seller is. Okay. But this is kind of your quick guide if they don't give any type of pricing expectations. Okay. And here's the thing. Why do you want occupied assets, Scott? I thought you like vacant assets. I want vacant assets so I can foreclose on the property. Here's the thing. Occupied assets are always going to usually be in better shape. They're going to have more exit strategies, either getting the borrower reperforming or deed in lieu or some sort of modification or a short sale or payoff. They're easier to reinstate and modify. Like I said, emotional equity, somebody wants to stay in the property, so they'll work with you. And there's also less capital expenditures. This company is actually taking care of the property. It means the HVAC is probably still there. The roof is probably in decent shape. Wiring there has been ripped out by the copper goblins and the plumbing's working. The vacant properties, you have issues probably on all 4 or 5 of these things, okay? Well, that's kind of that aspect of the markets and pricing guidelines. Let's dive into some different funding options, and we'll take a short little break again, okay? Questions about that before we move on? I've got a whole like dealer dud thing. Also, too, when you sign up for our 3-day workshop, we give you literally like a 5-page due diligence checklist to help you filter through things, what to look for, all that good stuff. It's really kind of the cheat sheet to help most people avoid issues and go from there. All right, funding options. How do you pay for a note? It's got to be cash. You're going to send a wire transfer into the lender. There's not a traditional tabletop like closing at a title company. You're not buying the property. Title companies don't want to do a closing if you're not buying title insurance from, and you don't need to buy title insurance from because you're not buying a new note. I mean, that note is still in effect. Okay. Now, yes, you do pull title and see what's on title so that you can see if anything's been, any second mortgage or third mortgage, any liens we put in the property, so that if you either have to foreclose to wipe those out, or if there's nothing, then you can do a deed in lieu and cash. Now, you can use your personal business lines of credit. You can't pay with a credit card, but you can use cash. Okay. I bought in my first note with a debit card, actually, $500. It's a little different story than what you've seen right now, right? If you're looking to grow your lines of credit to personal lines, I would check out getfundable.com. My buddy Merrill Chandler, we just had his first in command, Jessica DeBoer, on our most recent podcast episode. Most recent one? Yeah, I think it was. Well, we recorded this last week. 10 minutes about credit. Go watch that. That's so valuable for you to go watch that podcast. It was the #1 podcast episode of the month for August. Okay. But they focus on helping people get their fundability in order. Okay. Lines of credit, personal business. Get Fundable's had a 6-figure impact on our life. Okay. They've got a boot camp that they usually have, getfundablebootcamp.com or businessfundingmastery.com. It's something like that. They just changed the name. So, but most of the time you're going to use OPM, other people's money. Okay. Now, how do you find people with money that are willing to invest? You're going to look for people that have a self-directed IRA. Now, people can use their self-directed IRA, whether it's a Roth or traditional. They can use a solo and 401k, a SEP IRA, a self-directed health savings account, HSA. You can even use a Coverdale IRA, like an educational IRA, to fund these deals. There's a whole variety of different IRA accounts. Check out the video they're talking about. That's with formerly Quest IRA now. They're now some different company name now. But people use their IRAs all the time. And here's what we have found. 67% of people that have an IRA have 150 grand or more in it. Everybody on here that's watching this either live or the replays or on YouTube or whatever, everybody here is capable of raising $1 million in the next 90 days. And that means you too, Sylvia. How many of you think I'm lying? Say, I don't think I could raise $1 million in the next 90 days. It's okay. Be honest. Call me a liar. Call me a liar. You all are. Because here's the thing. If you pull a list, every one of you can go on to different county clerks. Most states, there's a few states that won't let you search by name. But if you go to your county appraisal district and search by equity trust or Quest Trust, it'll give you a list of everybody who's used their IRA to buy a piece of property. And it gives you their mailing address. All right. So if you send out 200 letters, and in our 3-day class, we literally go through the process on this. Here's the letter, what you say in the letter. Here's a sample deal or two that you put in there and talk about it. If you send out 800 letters, so 200 letters, and you get a 4% response rate, because on IRA investors, if you actually say their name and what the address you're contacting, you're going to get responses. Trust me, it's like shooting fish in a barrel. But if you get 8 people that reach out back out to you, 2/3 of those people, 8, are going to have 150 grand or more. If they're going to reach out to you, guess what? They're going to invest with you, because you're going to show them deals that they're not going to see in normal cases. And the great thing about IRAs is they have to do it passively. If you can give somebody an 8 to 10% return in their IRA for 36 months passively, they're going to put you on, like, they're going to name their kids after you. But, okay, let's look at this. 8 people, let's just say 6 of those, 75% have 150 more. 6 times 150 is how much? 900,000. The other 2 people, 50 grand each. There you go. You got $1 million in private capital. If you want to open an IRA, go to Rocket Dollar, a few other places out there that we'll share with you as well. But the contributions, this is actually like a flyer that we send out. Shows them what they can be putting away annually into their IRAs. Hopefully you have a self-directed IRA to do it yourself, because it's important. You can use your self-directed IRA to buy notes. And we see some great little deals that would be worth you using your IRA to put a performing note or small balance note into it that gives you a double-digit return that your IRA is not going to see otherwise. Okay. Most people have money sitting in an IRA making 0%. That's right. Billions of dollars. When I've talked to folks at former Quest, they manage $2 billion. And Nathan Long told me that about 35 to 40% of the money they have under management is sitting there in 0% accounts. $2 billion times 40, that's $800 million sitting there in 0% accounts, waiting for somebody to reach out to them. Hey, I got a deal you want to fund. And that's about the national average, according to what Nathan told me when he's talked to other people like at Equity Trust or New View, Mid-Atlantic, Pensco Trust. There's a whole variety of private capital waiting for you to do it. That's what you do. You send out a letter campaign, 200 people, cost you $1 a letter to send out to, and you follow up with it. You get people that reach out to you. You follow exactly. The reason I know this, because it works. We've got students that are raising millions and millions of dollars in private capital for their note deals from just sending out letter and direct them to a 10-minute video. Okay. So let me show you this. Let me just show you something. So let's do this. Okay. I'm going to show you exactly how we find these people, and that should help you. Sylvia, what county are you in? You're in Broward County in Florida. Is that right? I'm going to help Sylvia out here. I'm going to help our local deputy there. Yep. Okay. All right. So she's in Broward County. Let's go over to the internet. Let's go to a website called netronline.com. Netronline.com is a free website that basically brings all the public records together across the country. You're going to be on this website a lot doing due diligence or pulling values. So netronline.com. Make sure you guys can see that screen. Yeah. Go here to the public records online directory. And for Sylvia, she's in Broward County. So we're going to click on God's Waiting Room, Florida. We're going to go to the county, Broward. All right, so we're going to go to the property appraiser website. Now, here's the thing. In some states like California, Arizona, Nevada, Maryland, Virginia, Minnesota, some of those states will not allow you to search by a name. So you can't do it there. But you can go to the county recorder and search by name there, but not the appraisers, okay? Because of privacy issues, they don't want you driving around and looking at stars or politicians, okay? Website. So, but in Florida, it's open season. Click on go to online here. This should take you to the Marty Care Broward Appraisal. Oh, look at property search. Well, let's not select the city. Let's name here. Let's just type in Equity Trust. Equity Trust in Broward County. Look at that. 27 records found. Just like that. And if we click on this one, look at this one. Okay. Click on this. Equity Trust. We see the property is 7276 West Atlantic Boulevard, number 3. So they bought this condo. Kenneth and Deborah Kaufman of Trust of Equity Trust. You got 2 investors' names. So what do? You send Kenneth and Deborah, hey, Kenneth, Deborah, I saw that you bought this property in Broward County, Florida. with your IRA? Are you looking for more deals? Okay. See that it was when did they buy this? It's worth 200,000. So they bought this in 2023 for 225,000. They use their IRA as an investment. Okay. Will they have more money? Probably, but it's just a start. You get what I'm saying? Are you seeing this? Let's go back to search results. That's just one county, 27 people. Let's go back to property search again. Let's do bit search. Oh, it's just 3 in that one. So there's 27 total things. There's Deborah in them. But let's go to another. So let's do property search. Let's type in new view IRA. We got one in New View, Gary Aboff. This one in Pompano Beach, Florida. So that's 28 investors we just found literally in less than 5 minutes. Okay. Now, and you get the mail and address, send them a mail. Hey, saw that you used your IRA to buy this condo or this property. Are you looking for more deals to fund? Okay. Let's do a different county. So let's go over to different county. Let's go what's north of Broad. Let's go to Miami-Dade. Okay. Miami-Dade. Let's do the assessors or the appraisers website. Owner name. Let's type in equity trust. Boom. 66 possible matches. Yep, there you go. Same thing here. Equity trust for Miguel Echarte. Now, will this allow us to print these? Sometimes they have a download list where you can download these to Excel. I mean, you just copy paste those all. It's pretty good. Let's see what print results. What the print results look like? Oh, come on. But there you go. 66 investors right there. Yes, it takes you a little time to copy paste the name and the address, but there you go. 66 plus 26. How much does that make you? 92. And Sylvia, you've got to have a little bit more respect because you are a deputy. All right. Let's look and see what Quest IRA says there. If there's anything Quest IRA here before the name change. It's got one. Okay. Let's go over here and look in. Let's go back to Broward County. Do property search again. Nope. Quest Trust. Let's try Quest Trust. Well, nothing in Broward. It's kind of surprising, but that's okay. Question here. What county? Virginia's not going to let you search, Tony, because it's Virginia. So they're not letting you search by Equity Trust or Quest Trust. Okay. But what we could do, actually, what county is Fairfax, Virginia? Is that Fairfax County? Okay, we'll just do for the heck of it. See, you can check the recorder. So, like, let's do this while we're here. So the recorder's office here. This is Miami-Dade. So you do a standard search. Party name, Equity Trust. And just search. And there you go. That's 500 total documents with Equity Trust being a part of it. Now, somebody's go way back. What we could do is let's go back the last 3 years. Last 5 years. There you go. That's 318 Equity Trust. So you click on one of these. Let's make sure you can see my screen. And you're looking at, so the first party, here's the investor's name. Equity Trust Company, custodian for the benefit of Martin Lehman. You click on the document image, there you go. This is a balloon note. So you lent 75,000. There you go. To CDQ Investments, LLC. And look at that equity trust company custodian for Martin Lehman, who's post office. And there you go. It's 117 Hidden Hollow Drive, Palm Beach Gardens, Florida. So Martin lent $75,000 from an IRA in 2018. There you go. So you send a letter to Martin. This is Miami, back to Sylvia. Or anybody can pull that county list, okay? So let's go back over here to, let me share screen again. So let's go to Virginia. May not. Fairfax. Fairfax County or Fairfax City. You can actually do both there, which is. Let's just do Fairfax. All right, it might not here. So this one might be a little bit. So on this one, Fairfax mapping GIS. Go to data. Let's try there first. Yeah, see, it won't let you search. It says address or map number or map search. And you need a parcel. So it's not gonna let you do that there. Sorry. But you know what? Here's the great thing. Let's go to a different county or a different state altogether. If you go to Ohio, you're going to laugh about this, everybody. But if you go to Ohio and go to Lucas County, we go over to, in this case, it'd be the auditor. Click there and change it from address to owner and type in equity trust, I'm sorry. And hit search. It gives you 166 people's names. Let's change this to 100 per page. Boom, 100. And there you go. Look at that, easy peasy. And then guess what? You can click on mailing list and hit go, and it will do. Okay, select them all first. Give it a second here. And now you just downloaded an Excel spreadsheet with all the information you need for a mail merge. Just like that, the property address and then their mailing address. Boom, shakalaka. 166 people right there. 92 with what we did in Broward County. 258 investors there. Do you see it? Now it's all up to you, though. Now, it's all up to you to do a mail merge and send a letter out to them once or twice. Hey, I saw that you used it. Check out a couple of deals, or these are the types of deals that I do. Okay. One of the things that we like to have people do is send a letter out, and it directs them to like a one-page landing page with a 10-minute pitch deck video. It's one of the things we go through in our 3-day class. But that literally, it's like shooting fish in the barrel because investors are greedy, right? Oh, I got money in the sidelines. I need to do something. And I can't find the deals. You got a deal that I can find or a deal that I can fund and I can make the money without having to do any work? Let's sign me up. Did I hopefully just kind of blow your mind a little bit here? Do you see how it is easier to find investors now than it was ever done before? All right. We got some coachable people on here. Thanks to Winder. But that's the point, is they don't show you this. I don't know of anybody in the class that shows you this, right? The same thing. So go to do the assignment search. These are for capital. I'm not talking about, we already talked about note deals. Second go, I gave you all the places to go to find note sellers. Go to LinkedIn. Come on, Tony. Stick with me here. We're on the funding side now. Okay. You want to really then join me for 3 days next month. Okay. All right. Let's go back here. All right. There's other ways to fund your deal besides going and raising capital. if you're buying a note, sometimes you can get the seller or to collateralize your note. Sorry, people. Let me rephrase that. So if somebody's using an IRA to fund a deal, we'll either do a funding agreement with them, or we'll do an LLC where they fund in that LLC. We got part ownership and they own a part of that LLC. Okay, or we'll name them on the assignment as part interest in the assignment. Okay. You can do a collateral assignment. Some people want to hold the collateral, and that's fine. You hold the actual loan file. Some people have used notes and sold performing notes and sold their collateral off, or held, use their collateral on performing notes to get funding for new notes. Like there's a lot of hard money lenders that originate new loans. If they originate a loan for 150, they'll do a collateral assignment to the bank, and that bank will then turn around and give them another loan for 75% of the loan amount. Okay, there's a UCC1 filed at the county. We do a lot of co-assignments where it'd be like 50% interest of Scott Carson LLC or Inverse Asset Fund LLC and 50% Sylvia LLC. Okay. If you got a piece of property that's got equity, you can slap a second lien against that property as collateral for them borrowing the money. Or you borrow the money from them to buy the note. Okay. You could also sell partial off of performing note. Some people will do that. I'm not going to go into partials. Partials are the most over-exaggerated part of the note business. Okay. You're not going to buy a partial note from a bank anyway, most of the time. Now, you could sell it on a note that you own, but you're not going to buy a note on a partial, okay? So you can, we usually do a hypothecate, is what we do. You don't joint venture. Joint venture with somebody in an IRA, that's a no-no. You're just borrowing money from a flat IRA investor at a flat rate, okay? Joint venture makes it seem like you're splitting the profits, splitting everything. Just because it says 50% interest doesn't mean they're getting 50% of the profits. They have an interest in the note. Okay. We both have an interest in this note. That's why it says 50-50. But in the funding agreement allows that you're just getting an 8% or 10% return. Okay. Makes sense to Winder? Good stuff. All right, moving on here. If somebody brings $250,000, 250,000 or more to me, and they want to invest in deals, then we'll do a new LLC, separate LLC. We're both named on that LLC, and then we can split profits equally if they want to do that. But otherwise, anything below 250, you're just going to get a flat 8 to 10% return on your money. Okay, it's not worth me doing all that work. It's going to be a sizable chunk, and you got to do something on it to justify that split. Okay. And the investor funds your LLC and you borrow the money from them. Will a bank give me a note and loan? Not usually. They will not lend on notes. Some banks on commercial side might do a collateral, something like I talked about on the hard money lender side. Some banks, though, when they're selling non-performing notes, especially on commercial, may be willing to joint venture with you or may fund your note purchase of their own note. If you only bring 20% down, we'll sell you the note and carry the other 80%. We bought a note where a lender funded, they carried 85% of the purchase price in the note. We only had to bring 15% as a down payment. Okay. It was kind of nice. Now, on a bank note sale, if it's over $1 million, they may be willing to move from the non-performing side of the bank to the performing side. Now, usually what's going to happen on the note sale is either on a commercial, the seller is willing to do a deed in lieu or walk away from the property. Okay. If there's a second lien on it, you're not going to usually buy that. I mean, you can buy that note discount, but you're going to have to foreclose on it. So, and if you're going to buy a commercial asset, with commercial notes, it's different than residential. You're going to have to show some experience on a commercial note side versus a residential side. Commercial, it's all about operating the business and what's going on with that management. We've even seen banks foreclosing on some commercial properties where they allowed the investor borrower to still manage the property because, there was a big article. It was an article on LinkedIn today about a note deal in, where was it? Was it Virginia? Was it Fairfax County maybe? Where the bank's foreclosing, borrower is operating the property, and they're still going to operate and manage all the tenants on behalf of the bank. It's an interesting little story. Yes, it is very common, DeWinder, for IRA investors to invest in non-performing notes. Note investing is one of the #1 categories that IRA investors will fund. Now, that's the thing. It's all about education a little bit. Most of them, the reason we deal with IRA investors is they're educated. They're usually real estate investors. They've gone to workshops. They're not like trying to explain somebody new who's never done it before. Okay. And they like the non-performing side. Most of the time, if they're using their IRA, they're not using it for cash flow right now. So it's for non-performing notes, non-performing, they're not getting any cash flow. Their interest is basically accumulating, and you pay them when you either foreclose and sell it off the auction, or when you rehab the property and sell it back. Okay. Or sell it off. Very, very common. Okay. But the commercial, you're going to have team and experience, and show the bank you've got a team and experience for them to be willing to carry the note. Okay. And it may require like a chunk down, 15, 20% down versus 100% of the loan. Okay. Hard money lenders, I get this all the time. Oh, I got a hard money lender lend on the note. No, you'll have a hard money lender who will lend on the actual property. You're buying the note. You don't own the property yet. Okay. They like hard money lenders, like short-term loans, 6 to 12 months. They're making points on the spread. They like to be in control of the asset, the first lien. I get it. It would make a lot of sense for them to lend on notes, but they just don't seem to get it. Okay. They make their money on the points and the churn. Now, they might have some notes for sale. I get a lot of hard money lenders going to oh, we want to sell our notes at par. I'm like, well, that's good. It's at 12%. I'm not paying par. Well, why not? I said, because I'm not going to pay full value right now on a property. Plus, I'm not going to buy on a note on a property that's unfinished or going through rehab. I want a finished product. Okay. But hard money lenders, it can be short-term loans. If you feel like lending money out and doing that, you can make usually a 8 to 12% return on your money. Usually if it's a rehab, a lot of these hard money lenders will service their own loans still too, which can be kind of a benefit for you. What else do I add to the funding amount when I'm funding? Is it just the purchase price of the note, or is the workout cost? Well, we do a bit of both. If there's back property taxes, we'll deduct that from the bid amount, but we still add that into the funding amount. So I'll give you an example. Say we're paying $60,000 for a note is what we would bid, but there's $6,000 in back taxes owed. So our bid wouldn't be 60, it'd be 54, but we're still going to have the investor fund 60 and a little bit more. Why? Because if we don't have the capital for workout costs, but we're buying at a price that makes sense. So if we're buying at 60 and let's say it's worth 100, clean asset, I need a lot of work besides maybe paint and carpet and clean out. So if it's worth 100, as it sits right now, it's going to take us, say, 6 months to foreclose. Well, we can probably bet that appreciation is going to go up a little bit, right? So we're paying 60, $6,000 in back taxes. So we're basically bidding 54 to the bank. We'll probably have the investor fund 60, 65. Depends on where it's located. Okay. So we're always going to evaluate the property with a local realtor or broker price opinion from a local realtor. Or if we don't have a local realtor, we'll pay there's a third-party company that can pull that for us. We're always going to send somebody buy the asset to put eyes on it so you don't have to. We're going to budget in the foreclosure costs, which could be $1,500 to $5,000. Any back taxes, any workout or servicing costs. What I figure in is that if it's a non-judicial foreclosure, I'm going to budget in $3,500 for workout, servicing, and foreclosure costs. If it's a judicial, I'm going to figure in from basically $5,000 to $6,500 for foreclosure and workout servicing costs. Servicing costs are going to cost you about $1,000 a year, $1,500 in some cases. Foreclosure is going to be somewhere between $2,500, unless you're in a really, really fast market, up to you $5,000 or more in the longer markets. So that's kind of what I figured. About $5,000 on average for servicing and workout costs. Foreclosure in Florida might be a little bit longer. So I'll bump it to $6,500. But as long as I'm still below $70,000, it's worth $100. If I'm at $65,000 or $68,000, they fund it. We pay $54 for the note. The other money is held in our escrow account or a separate checking account for the expenses and workout costs. It doesn't mean you go freaking to Las Vegas at that funds. No, you hold on to that money for workout costs till either A, you foreclose and sell it off, or if the borrower comes to the table and makes up payments and then starts paying on time, great. The borrower modifies or reinstates or starts paying, you can do a workout. Then you start paying your investor a quarterly payment, not a monthly payment, quarterly. Okay. But you want to make sure you know what you're doing. That's why you put eyes in the ear. And part of the reason we buy occupied assets is we know it's going to be in pretty good condition. Yes, just budget for paint and carpet most of the time. You're also going to put forced place insurance on a property. That'll vary by state. Florida is more expensive than others, but If it's not in Florida, we'll budget about $700 to $1,000 for forced place insurance. There are HOA utility liens. This is why you pull and check title to see what's going to get wiped out or has to be paid. Obviously, if you're going to turn power on and a property to sell, that's going to cost you. And you're going to figure in $500 to $1,000 in marketing costs or asset management fee in the deal. Marketing costs like to mow the lawn, your CRM fee to market email out, some of your memberships that you have for marketing. Those are some costs that are still costs each month, but that helps you. If you're making 20 offers to get one offer accepted, you may have to pay some due diligence costs for like BPOs on 5 or 10 assets that you don't bid on, or you cancel your bid because the values come back and they're less than what you saw them online, or the conditions in worse shape. Well, that $85 you spent for a BPO was an insurance policy to make sure that what you're really buying is what you're really buying. If the seller tells you the value is 100 and your broker goes out and comes back and says, oh, it's only worth 50, well, that's enough information that like it's not worth 100 what the seller thinks it's worth. It's only worth 50. I'm either going to I'm going to reduce my bid and you're going to accept it, or I'm just going to cancel it and move on. Okay. You want to stay though 65% of fair market value of as is fair market value or below that when you're funding and using other people's money. Just a good margin. Just make sure you're coming in below value. Okay. And one of the things I always tell my investors, and these are 5 things to completely hang your head on. 1, we're only buying first liens. We're in the most secure position besides a tax lien. Okay. We buy first liens. If there's back taxes owed, we'll pay that. Okay. So the only thing that wipe us out really is an act of God, and we put insurance on the property. Okay. We're buying below 70% of as is value. If it's after repairs higher, great, but we're focused on something. We don't focus on after repair value. ARV does not occur in the note business. We're as is value. Okay. We're using servicing companies and attorneys to collect and foreclose on. They're doing all the heavy lifting. Sometimes we might have to show up to a foreclosure. Sometimes I've had to fly out to like Palm Beach County or Miami-Dade every once in a while to actually show up at a foreclosure trial. Okay. Forced place insurance. If the borrower doesn't have insurance on the property, we'll put it on there, and either they reimburse us or it goes on the legal balance and we foreclose as a lender advance fee. Okay. And we're always checking title and the collateral files to make sure we have the right to foreclose, having those reviewed. Okay. If this isn't clean, if the title isn't clean, or stuff that we can't wipe out, or if the collateral file is missing or stuff on the collateral file, we're either going to cancel and move on, or wait for that seller to correct any flaws in the collateral. All right. Those are the 5 things. Buying only first lien, 70% of as is value or less. We're using professional servicing companies, attorneys to collect. You're not wiring me the funds directly. You're wiring to our escrow account. We're using, like I said, professionals to handle the servicing, the workouts, all that stuff. I'm not going out knocking on the door trying to collect. That's what a lot of people think investing is, that you're going out knocking on the door. It's like, no. I have professionals doing this all across the country for me. Okay. If they don't have insurance on it, we'll put insurance on it. Obviously, if taxes aren't paid, we'll pay the taxes to avoid a foreclosure. And then we're going to check title and collateral files, make sure that everything is clean and clear there. Okay. Questions about that before moving on? All right. Good stuff. Let's take a quick 5-minute break, everybody. 5-minute break. So some of this stuff that in Find Investors, we talked briefly about some things. Real estate investment clubs are a great place to go network for finding investors, meetup groups. There's meetup groups in just about every city out there, some sort of real estate investment club. LinkedIn, you can type in note investors, IRA investor on LinkedIn and find people out there, a real estate investor, all sorts of keywords. There's LinkedIn groups and also off of people's profiles. You can go to Connected Investor. You can go to Bigger Pockets to look on there. Although Bigger Pockets has a tendency to be more of a dumpster fire recently because of all the changes they've got going over there. But we found and raised capital on all those spots. Okay. Bigger Pockets, you can do like a keyword search and put in 50K to invest, 75K to invest, 100K to invest. And people will literally go on there and say, hey, I got 50K to invest. What should I do? I got 100K to invest. What should I do? When you have those keywords in your profiles or your settings to watch, You can log in once a week, see who's posted, hey, I got 50K to invest, and then go send them a message. Hey, saw that you got 50K to invest. What should you do? Maybe you should invest notes. Here's what I do. Here's my pitch deck. Okay. Or go to self-directed IRA custodian trustee events. A great way to network with other IRA investors out there for you. We talked about this. I showed you guys this by going to the county records to look and find IRA investors. I got a little ahead of myself on this stuff, but that's okay. People who've used their self-directed IRA have used it to lend or buy property. So looking at not only the appraisal districts or the assessors to find people who have purchased property, that works, like I said, about 75, 80% of the time. But if you're like in Fairfax or California or Arizona or Minnesota, where you can't search by the name, then go over to the clerk or recorder and search there for document filings. Look for a deed filing or a release of lien, and that will show you people who've used their IRA to lend money out of. Great way to raise capital. And then just send them a list, send them an email. Equity Trust, Quest for some of the bigger names. Quest is no longer around. They go by different names. This just happened like this last month, so I'm going to update my presentation here. But just fun, sending people a letter. I mean, think about this. If I sent you a letter and said, hey, I saw that you use your IRA to buy this investment property. Are you looking for more deals? What would your response be? Be honest. Would you be scared or freaked out, or would you look for more information? If somebody gave you, hey, here's what we do, would you take a look at it and say, I got 50K sitting more in my IRA to do something with. Let me reach out and see what they have available. Now, not everybody's going to be a yes, but it's a higher hit rate than just sending out some direct mail campaign to anybody who's got a 401k or an IRA or trying to teach note investing to people. Because if somebody's used their self-directed IRA to invest in a piece of property, you've got that in common with them. Okay. You're both investors. You're both looking for deals. IRAs have got to be passive for most of the time. That means they can't go out and work on the property themselves or rehab the property themselves. It's got to be passive. So note investing is ideal for that. But honestly, anybody got any red flags to that? If somebody sends you a letter, hey, I see that you use this property, use your IRA. Are you looking for more deals? I'd love to talk with you. I'm assuming by your guys' no response, you're like, yeah, I'm pretty comfortable with that. I would pick up the phone and call them. Okay. That's what people do. You can also, if it gives you the address of like Equity Trust's main business account or main address, I will jump on Google or White Pages and I'll search for them. I'll do a reverse search. Or if I got a unique name, I'll go over to LinkedIn and find that person on LinkedIn and contact them directly on LinkedIn or Facebook. That's worked really, really well in raising capital. Hey, don't mean to bother you. Are you the Sylvia that owns the property in Broward County that use your IRA to buy it? If you are, I'd love to talk with you. I'm also an investor. I've got deals that you might be interested in funding. I'd love to talk about if you're interested in looking for more deals for short term. It's a simple conversation. And the more no's you get, the more yeses you're going to get. It's easier to do that than sending out a letter campaign. And after a letter campaign, it costs you money with a low response rate. This gets responses. Okay. Oh, so here's the thing. Here's the types of deals that we do. Here's the experience. That's part of the pitch deck is the experience of your investors. Yeah. Some people, here's the thing. Most people, if they like and trust you, they're not worried about it. Or if the deal makes sense, the deal makes sense. Or you rely on the experience of your servicing company's attorneys. It goes to the same thing. What if they want to see your history? If you show them the types of deals you're doing in case studies, which we will share that with you, there you go. You got to start somewhere. You just got to start somewhere. Is what it comes down to. Go buy a note for $5,000 and then go use other people's money. Or I'm partnering up. I got a partner. I got a coach that helps me find these types of deals. That's one of the biggest things that help people, especially with our coaching students. They're like, can I help you? Yeah, I'll jump on those phone calls. Like, hey, here's the types of deals we're doing. Here's the numbers that make sense. Here's why it's a slam dunk deal. Here's what could go wrong, which is not much. What could go wrong? We don't pay taxes. Well, we're going to pay taxes. What could go wrong? They delay and file bankruptcy. Okay. But now we have an attorney to talk to. And it's either going to be they start paying on time again, some sort of modification, or if they don't do that, then it's a bankruptcy is dismissed and we finish the foreclosure. This is the greatest thing about notes is your experience is the least important than it is would be like trying to buy a fix and flip property or dealing with a rental. That's the thing. Okay. We already talked about the recorder's office, so I went through that already with you guys. You can also buy custom lists of IRAs. Okay, you can go to some of these list services and just buy a generic list of IRA investors where they may have an IRA with a 401k company, not a self-directed. I mean, every IRA is technically self-directed, but most people have an IRA where it's directed through like a fund, like a Fidelity, where they can only allow you to pick the funds they offer. They don't allow you to pick like real estate or notes. Okay, like a true self-directed IRA custodian. Okay, but you can buy a list from like Melissa Data, Exact Data, by county basis, by city level, Exact Data. You can even buy it where the list has people that have 150K or more in their accounts, and it gives you their email and address and phone number. You can also buy lists of employees of different companies. When we're going for COVID, and there's a lot of these companies that were laying lots of people off, like Halliburton. You know, I could go buy the whole list of Halliburton employees in Houston, Texas at 25 cents a lead. Think they've got some money in their IRAs they're looking to do something with? Heck yeah. And if you got an email address, then it's pretty easy. But the thing is, if you're buying a list of, at 6 to 14 cents a lead from Exact Data, it's going to cost you $1,000. And $1,000 is going to get you like 14,000 names. Well, that's a lot to get into your CRM. But we use those lists by uploading like Facebook and some other smart things. You don't have to do that stuff. But here's the thing. Every real estate investor with an IRA started brand new somewhere. Everybody got dressed the same by putting on one leg at a time. Everybody got started somewhere new. If you're so worried about your experience out there, go do something else. Because, ladies and gentlemen, we all got started brand new somewhere. Everybody. You got to get outside your comfort zone. Finding excuses for people not to invest with you is you looking for excuses not to do it. Sorry, it just is. You have to get beyond your limited thinking. You all can do this. If you only got 25 grand or 100 grand, that's great that you have that. But guess what? It's not going to get you what you need at retirement. If Warren Buffett is going out and raising capital for deals, then it's good enough for you to raise capital yourself. Oh, yeah, they got track records. Well, guess what? You've got a track record. You've been a deputy for so many. You've got this track record of whatever you've done before. Okay? Or you're aligning yourself with people. Or you make it a no-brainer. We're buying this in Texas, or it's a fast foreclosure. It's worth 200. They owe 280. We're buying it at 100. The deals make sense. You don't do skinny deals. That's part of the thing. Share the deal. Break down the deal. Hey, we're going to have you fun. This is the deal that we're looking. Here's what's A, B, and C. This is why we have servicing companies and attorneys. They handle the heavy lifting. So where can you post these types of deals? Hey, post deals from past experience. Post deals from others. Other case studies. Post deals you're working on and reviewing. Never mention safe or guaranteed. That's a no-no. Okay, that's not so good. Create a short pitch deck video. I mean, I've done thousands of deals, but you can learn from what I'm doing in like the short little videos I'm doing. The one that, hey, here's a deal that we're working on, or here's a case study we're evaluating. Those are all things you can do to build credibility. People really aren't worried so much about your credibility. I mean, they're worried about your credibility. They like and trust you. Experience is never really one of those things. Yeah, in some cases it will be, but rarely is that it. Does this make sense? Do the numbers make sense? Do I like and trust you? Worst case, can I get my principal back? Yeah, you're doing those 5 things, okay? You got to get out and start talking to people. Because if you let, your insecurities, then you're never going to do anything. You've got to get out and start talking about your focus, your team, your vendors. All their experience will offset your stuff. That's why I say note investing, your experience is the least important. You're using vendors, you're using servicing companies, you're using attorneys. You got me in your corner to help you out with somebody who's done thousands of deals to help you make sure you're doing a deal and not a dud. Okay. Now you're going to qualify investors. Not only are they interviewing you, you're interviewing them. Are they currently invested in real estate? If they are, great. Or if they have, great. If they've never invested in real estate, you're not going to probably get them to get rock and roll unless you're close friends and family. Are they accredited or sophisticated? You need to know that. How much are they looking to invest? You got to ask that question early on if they reach out to you. Because if they say $5,000, that's not worth your time. Okay. Somebody's friends your letter. Great. How much are you looking to put to work? Oh, $10,000. I'm sorry. That's just not enough time or money to do anything with right now. I had a couple students who wouldn't ask that question, and they kept getting frustrated because they kept talking to people that only had like $5,000 or $10,000. I'm like, but why are you giving them a third or fourth phone call or meeting with them? Have you not asked them how much? Oh, I know they do. Well, when they asked them, they came down to $10,000. I'm like, you need to ask this question on the front end. Get good at asking uncomfortable questions. Well, why is it uncomfortable? It shouldn't be. How much are you looking to put to work? How long are you looking to invest? Those are important questions to qualify these people to make sure that they're a good candidate to be on your deals. Not everybody is going to be worthy of your time or your energy. Are they active or passive? People that, oh, I want to be more active. I want to make like 15% of my money. Well, that's great, but then you need to go do it yourself. We're only giving an 8 to 10% or an 8 to 12% return on the shorter term stuff. Okay, and it's passive. What kind of returns are you looking for? Or how long is it? One of the things I always like to ask people is like, okay, tell me about what you've done. What have you invested in? Oh, I've done some fix and flips. I did some rentals. When did you last do a deal? Oh, it's been over 2 years. Oh, okay. So you're saying that this $100,000 that's in your IRA has just been sitting there for 2 years. Is that right? Yeah. Well, great. That's awesome. We can put it to work for you and give you an 8% return for the next 2 years. Oh, I want 15. Well, I'm sorry. 15 is for an active investor. And you just told me you're not active. I'm not going to give you 15% when I'm doing all the work. I'll give you 8% as a passive return. That's better than you're getting right now. Well, I made 24% on my one deal. Okay, you made that 3 years ago. So you got 24% in year one and 0 in year two, 0 in year three. Well, that's 8% on average. Well, why don't I give? And that's why I'm giving you 8%, because that's better than you having to do anything. I know it sounds like I've done this a lot. I have. But you practice this. You go through this. And this is part of why having a coach or going through our 3-day helps you overcome a lot of stuff. And we tell you always use an investment questionnaire to help you walk you through this. And a very, very simple 1-page investment questionnaire can help you get through a lot of things. Okay. A couple case studies, investment questionnaire, and knowing what you're talking about as far as what you're looking to do and the opportunity. That's really what you need. Now, there are investors you want to avoid, people that are unfamiliar with any type of real estate investing. People wanting like short-term, 90 days, or I want like 15% higher. No, those are not the right investors for you. Investments really below 50 grand. You might go to 25, but don't go below that. Those people will just drive you bonkers. One of the great things about social media, you can find out if people talk bad about it. If you ask somebody if they've ever done a deal or they've been in a lawsuit, just let them sit there and talk to you. If they're all suit happy, I sue this guy, well, that's probably not one person you want to deal with. Well, I talk bad about everybody. I say this because I've learned from my own mistakes. Okay. You got to learn, and not everybody is a yes. Sometimes saying no allows you to sleep better at night. And ask for references. Hey, you've partnered with people who can give me a reference or two. I just want to make sure we're a good fit. Sometimes it's not a good fit, and that's okay. We can still be friends. You're interviewing them just as much as they're interviewing you. You have to realize, here's the thing. He or she who has the gold makes the rules. The gold is not the money. The gold is the deal. You have a deal. You have oxygen. You have the cure for cancer by finding these deals. Money is the least irrelevant. There's so much money out there in a good and bad market. There's so much money out there. You don't have to worry about that. What you have, and that's what you have to focus on going and finding. That's why we start this whole thing about how to find deals, is that's the gold. He or she who has the gold makes the rules. The gold is the deal. If you have somebody who has money, but they want too much, no, next. You give them the whole Heisman pose, the stiff arm, and go on to the next person. I can't tell you enough. Always require investors to fill out the investor profile questionnaire, send you an email if they like what you're doing, send a pledge letter. Say, hey, Sylvia, hey, Rami, I enjoyed what we talked about. Attached is my proof of funds. showing that I'm interested in doing deals with you. Yes, it shows 200 grand. I'm pledging to do $50,000 with you on note deals. The reason you ask these three things is if you get these three things, they're likely to fund. If you don't get these three things, they're not going to fund. It also works in your case that you're still going to have people flake off. So the reason you get these things, so if somebody does leave you high and dry and flakes and won't fund your deal at the end, and you can't get another funders, or they do it at the last minute, you can show the seller who you're buying these notes from, hey, I did have proof of funds. I just need to go to my backup investor. Okay. But if you don't ask for these things, they're not going to fund. I can't tell you that. It's so important. All right. You got to ask them, where's the money coming from? Oh, it's coming from my IRA. Who's your IRA with? Oh, it's with the equity trust. Okay, great. Oh, it's with Fidelity. Okay. It's Fidelity is okay. It's great, but you're going to have to move it to a trustee because Fidelity will not allow you to invest in real estate. You're going to have to move it to a transfer in kind over to like an equity trust. And that can take a week or two. Okay. It just takes 3 business days alone for them to transfer the funds from any type of fund into cash. And then it's like another week to transfer the funds over because they like to drag their ass. Okay. But that's what you need to do. And this is important. Have paperwork created by an attorney. We've got some funding agreements, pretty easy to use. No, I'm not going to send you a funding agreement. We only do it with our one-on-one coaching students, but it's pretty simple to create. I allow their CPA or attorney review all day long. They want to make a change or two here or there. Okay. As long as it makes sense, will make sense. Always use agreements. It outlines when things go wrong. Like our funding agreement talks like it's a 24-month period. They can cancel this agreement, but if they do cancel the agreement, they're only going to get 75% of the investment back because there's a penalty of 25% unless they do it within 90 days of the end of the agreement, and you have to give me 90 days to refinance you out. Most investors, even in this market, can't make 6% or greater. They might get 6% of certificate of deposit or certificate of disappointment, but that's not them making it. Okay. They're not going out and finding deals. They're not being active because they're scared to death. So you have the cure for cancer. You have the gold. If their money's making 0%, 6% is an above average return. I can't tell you that enough. 8%. Now, if you've dealt with somebody who's been an active investor, 8% might not be enough. You might need to go to 10 or 12. That's okay if the deal makes sense. But if you got a deal that if you get reperformance at 16 to 20 and they want 12, it's only going to make 16. That's not a good deal. Say, no, I can't give you 12. That's only going to yield 16. I can give you 10, or I can give you 9. All right. Payments and communication. If making payments, make them quarterly. Avoid monthly. If it's a non-performing note, we sit in agreements that we don't make monthly payments until it's been reperforming. Okay. We set up a portal, pretty simple. You can use Dropbox, Basecamp, Boxby. There's a whole variety of different things you can use to share information with your investors. Never, ever pull investors' money together. One investor per asset. When you're starting off, using 50 grand from one person to fund one deal. Great. Don't take 25 grand from 2 people to go fund one deal at 50. That's pooling money. That's illegal. Okay. Now you can partner their money with your money and go buy a note, but don't go take 2 different people's money, pull together to buy one. That's no good. Go market some more. There's plenty of money for good deals out there. If you got a good deal, there's plenty of money out there to fund your deal. You just have to open your mouth and market it. Okay. Trust your instincts. But ladies and gentlemen, there's plenty of money out there if you've got a good deal. Okay. Nobody gives a rat's ass about your lack of experience because your lack of experience doesn't mean much. When you have a servicing company who's done it 60,000 times and you got an attorney who's done 10,000, okay? And it's paying them. People will get excited about returns. The fact that you're buying a note so cheap, well below balance, well below value, it's a no-brainer, okay? All right, let's dive into the marketing side of things here real fast because marketing is one of my favorite topics besides the raising capital side or the finding us side. But marketing is great. There's so many different ways to market. And remember, 80% of sales are made after the 5th contact. Okay, it's all about touching base, touching base, touching base. Part of the reason I post 1-minute videos every day across all my social media platforms is so that I'm touching base with new people every day, or the same person is seeing my posts several times throughout the week. Not everybody I'm connected to is seeing every post I put out because the algorithms work where only 5 or 10% see your stuff. But this is why we do it constantly. So it's an ever revolving aspect of things. Now, you don't have to do what I do, but you got to understand, you got to share what you're doing. Expect to post or market regularly and often. You can automate some your postings with buffer.com or hootsuite.com. Buffer.com is better for you guys. It's cheaper too. There are three most important things to use in today's market when it comes to marketing. One is an email, CRM. We like keep.com. They're our preferred vendor. You can use activerain.com. They're not as friendly, but an email blast out to your database. You're going to be making connections. You got to grow a database. It just is the fact. Okay. Social media does not count as your database. Okay. LinkedIn. You all need to have a LinkedIn profile that says something about real estate investing. I'm a real estate note investor. No, you don't need to go create a new LinkedIn profile. I'm afraid my boss is going to see. Well, is your company or boss using LinkedIn to market? If they are, then go block your boss. If they're not, then don't worry about it. Okay. And video marketing. YouTube is the easiest thing, cheap, free, 1-minute video on what you're working on deal. YouTube is our primary aspect of it, but we do share that little video or long videos everywhere else that we can. It's just a blanket. How much, I mean, you think about it, are you going to throw one line in the water? I mean, how many fish are you going to catch with one line? One fish, right? Well, if you throw a net out, you're more likely to catch a lot more fish. Okay. It's not difficult. You just a different skill set. You just got to develop. It's not hard to do. I know some of you are like, oh, I come from an anti-marketing. I can't share anything. I get it. So share, tweak it, how you have to be done. Everybody can market. Okay. Email marketing. You're going to be using this regularly. It's still the #1 ROI for marketing. 4,400% for every dollar spent on email. You're going to get $44 back. That sounds like a pretty good return on investment to me. You're going to be using this out through Tuesday, Thursdays through your email investor database, sending out an email to your warm contacts, your business card, your networking, at least once a week. I like to send it Sunday nights a lot of times, or once or twice during the week with something new. What do I talk about? There's a whole variety of things. Because here's the thing. Most people are like, well, what do I talk about? I don't know anything. I'm not that interested in sending an email out once a week. Well, maybe you aren't. Okay. But there's plenty of things that you can talk about that adds value to your investor database. The first thing is every month has a holiday, right? What do we have coming this week on Monday? It's Labor Day. Hey, happy Labor Day. Hope you're having a great Monday. Have a long, safe weekend. Okay. Every month has one. That's one email right there once a month that goes out there. Upcoming meetup or networking event. Most of you are going to have more of a warmer market and more close to where you're living. So when you send an email blast out, you talk about, hey, I'm going to the local real estate club. Would you like to come join me? I'm going to go learn about rentals. We're going to learn about fix and flips. We're going to learn about notes. Or I'm going to the local B&I group. Come join me. You know, that's once a week. I mean, sorry, that's one time a month. An upcoming event. I'm attending this crazy note investing class with this idiot Scott Carson. Okay. I'm learning about distressed debts, distressed real estate investing. Come join me. Or if you'd like to learn more about it, there you go. Personal event, something fun. Family member, hey, we took a vacation. Or school's back in session. I can't believe my little Johnny is a senior. He's still sucking his thumb. Or little Susie, she's a sophomore, still wearing diapers. You don't get what I'm saying. My husband Steve, still a raging alcoholic. He's been out of work for 2 years. He's really holding out for a management position. Okay, we all get those letters or emails from our family like at Christmas time. But you could do this. Hey, here's what we're working on. Or it's the kickoff football season. Little Johnny made the varsity. Okay, little Susie's on the pep squad. I got a great example of what not to do. Okay. Last night, we go to a high school football game here. We live near a high school, Westwood High School, big 6A high school. Don't have a very good football team, but I'm like, hey, we'll go. Why not? We'll support the kids that are near here. We went and watched a lot of baseball, got to some families. They were playing up near where some of our best friends live. I was like, oh, we're only a block from your house. How about we go to the game? So we go to the game. They got the football team, both sides, and then you got the band. They get the pep squad, right? So at halftime, the pep squad and the band comes out there, teams at halftime. I'm going to concession stand. I'm coming back with my buddy Elijah. Well, who do I see walking up? I see my buddy Boyd. Boyd's a realtor mortgage broker, right? And I knew you got 3 kids. I'm like, what are you doing here, man? He's like, oh, my daughter's in the pet school. I'm like, I never knew that. I get a letter from you once a month, and I've known Void for 30 years. Known him for a long time. Always known he had 3 kids. I didn't know that his daughter was a young. Didn't know she was on the Sun Chasers. I'm like, boy, that would be something to share. You know, that's something to be proud of. You know, they get this record, this award-winning dancers. I'm just like, oh, that's a great marketing piece. It doesn't always need to be about note investing. Invest with me. Invest with me. You know, and that's the thing I tell him. I'm like, you got to invest. You got to invest in sharing. Share. Besides just the best 12 hacks for selling a house. You know, so many people have outdated marketing. Like most realtors send out a flyer once a month, and it's like the biggest piece of shit. Sorry, pardon my French, but it is. Nobody cares about the 12 ways and the 12 recipes. That doesn't add value. What adds value is knowing the value of their house or what's going on in the local markets or something personal. Well, I'm just referral based. Well, great. Share something about you personally. What's your hobby? There's more to you than just being a broker or a real estate investor. I mean, how many of you guys do something besides investing right now? Like you have a career. What's your kind of job, and how many years have you done it for? Okay, like one guy reached out to me and said, "Hey, you know, I used to work with investors. Right now, I deliver for Meals on Wheels." I'm like, man, that's really rewarding. That's something really cool. You should share that. What do you mean? Share what you're doing. Tony's been in recruiting for 24 years. Wow. Any specific niche in the recruiting phase, Tony? Tech. Okay. Do your friends, family know that you're in the tech industry? That could be something. Hey, maybe you guys didn't know that for 24 years, I've been in the recruiting in the tech industry. Okay. But what you probably didn't know, though, is I'm also an active real estate investor. Or Jefferson. Hey, many of you know me that I've been a software engineer working for blank company for the past 25 years. But many of you didn't know that I'm also, my niche that I like working on is also I like investing in real estate locally. I like focused on distressed assets or rental, whatever. I like buying real estate. Who doesn't like real estate? Who doesn't like those shows, Flip This House, right? Everybody loves those shows. But there's so many times we don't share what the heck we're doing because, they tell us not to. Yeah, your work will brainwash you. You got to do what you're doing. You can't market. Well, guess what? What I do outside of my job, my 9 to 5 is none of your business. It's none of ya. Okay? Investing is it's a hobby. Somebody in the finance industry, like when I was a banker, I would have to sign like an OBA, an outside business arrangement. As long as I'm disclosing that I'm doing that, it was fine. But what you're buying notes and flipping houses or whatever, that's, hey, especially if you work with a job that doesn't have any retirement, screw them. You're building your own retirement. You better market what the hell you're doing. Or some people have started like investment clubs at their job. Hey, I know we got a lot of people here have money looking to do some stuff. Let's do a happy hour and talk about investing. Here's what I'm doing. Like IBM has that here. They have a real estate investing happy hour here in IBM in Austin. Okay. Why not? The idea about sharing what you're working on or sharing, hey, I'm driving by this house. Who doesn't like to drive for dollars, right? Like literally tomorrow, I'm driving out to Steiner Ranch to look at this $2.5 million property. Am I going to buy the note? Hell no, I'm not going to buy the note. But I'm still going to take a picture of the property and share it. Hey, I'm looking at this deal. Why am I not buying the note? Well, I found out when I was doing my due diligence, the borrower was unemployed, but guess what? He went back to work in August. So it's probably likelihood he's going to reinstate the loan and pay his 90 days of 3 payments. So if it happens, that's not going to be a good yield to me. I don't want to have $1 million tied up at 9%. So it's a no-go, but it's still an interesting deal. It's still a pretty property. You could do that. Share something. Fourth thing that you could share, pretty simple, is a deal that you're working on. Past or present deals. People love case studies. Okay. Like Sylvia, you could take a picture of a property. Probably don't need to want you to do it, but hey, I had to evict this property, or hey, I'm driving by this property. Here's a picture, working on this deal. I mean, there's tapes I get into Florida all the time. You could just do a screenshot or an image, and here's a picture in Broward County that we're looking at buying. or a note in Miami-Dade that we're maybe going to buy and foreclose on. Okay. I know plenty of police officers that we've had as investors. As long as they weren't showing their badge, what they're doing, they were fine. Okay. But those are the things. And a holiday, happy holidays. Hey, what you doing? I'm going to an event. You want to go? So we're celebrating something fun, 25 years of sobriety, or my daughter doing well, or the family doing this. I'm so proud of my wife. And here's the deal that we're working on, or a past deal, or a past flip, or a past something. That's your success formula right there. For 99% of you, that works. What's the other 1%? Well, the other 1% is like doing other things. Like I have a podcast. I have other things I do, right? I teach. That's different. But you can share. Like people know for the most part, they get to know from being around and seeing stuff. That A, I like real estate. B, I like sports. C, I like to cook, right? And then I've got Anna. We got some cats. All right. Those people, if you look at stuff, that's what you see. Real estate, note investing, sports, cooking, share a little something else. That's the beauty about social media, is it helps you share it with your social audience. Okay. And well, what about the haters? Well, then unsubscribe, block them. You don't need that negativity. Get rid of them. Okay. If you have one negative Nancy out there, guess what? Sayonara. You will never have but somebody doing more than what you're doing look down upon you, because they respect the hustle. The only time you'll have trolls or people that will say something negative is they're jealous or they're honestly beneath you. So block the people that say negative things. God knows we got enough negativity with the politics, enough people blocking because they're voting Democrat or voting Republican, or you like Trump, or you like Harris, or you hate Trump. Fine. See you later. Next. You ain't paying my bills, so you can shut the F up. All right, let's move on. And then besides mailing out to your warm market once a week, emailing asset managers 1 to 2 times a month at least. And it's going through that process, the first email, second and third email. But that's email marketing for you. That's what you'll be doing. Still your biggest bang for your buck. LinkedIn, oh my gosh, it's so free to do. Complete your profile 100%. It's your social media, business resume, or business website if you don't have something. If you're targeting asset managers, they're going to go try to find you on LinkedIn. Okay. But it's also easy to find investors and bankers on there. We use a tool called Octopus CRM. I've used it for years. It's helped us grow from 6,000 to 30,000 followers. Okay. It helps us maximize our connections with real estate investors, asset managers, and real estate investors all across the country. And part of the reason why you wouldn't want to post articles or images to LinkedIn is only 3% of LinkedIn users post daily. Even fewer post on the weekend. So if you're out looking at a property, take a snapshot. If you're looking at a deal online, do a screenshot and save it and upload it. That adds value. LinkedIn's algorithm is less intrusive, shows you more people than Facebook does. Facebook is just a dumpster fire, okay? But still posting there because your warm market will see. You never know who's going to see things, okay? And there you can join and post to groups on LinkedIn. There's some big real estate investment groups of 400, 100,000 people on there that you can join and network with, okay? And you can import some smaller lists on LinkedIn to help you prime the pump and get rock and roll. But just get started sharing. The free version only allows you to connect with like 20 to 100 people a week. Go ahead and upgrade to the paid version and allow you to do a lot more people. So to like 20 a week to 100 a week at least, if not more, okay? And here comes the scary thing. Oh my gosh, video marketing. This is such the easiest tool to use, better video camera and easy to share. Like 90% of the videos I do straight from my cell phone. Selfie video, 1 minute, and then I upload all from my cell phone. It's easy to do. YouTube is the second largest search engine owned by the #1 search engine. We use TubeBuddy to help it grow. Short videos do really, really well. It's YouTube works 24-hour a day, 7 days a week, 365 days a year advertising. Besides uploading a video, we use descriptions, keywords, and thumbnails when we can to make it up. But that's the thing. You got to start planting seeds, and these are all being seeds that you're planting long term. Facebook Live is a 24 to 40 hour lifespan, not really as even that anymore. LinkedIn Live does really, really well with shorter videos. And I used to bash TikTok back when it was just all dancing and popping and locking. I really like TikTok. I actually become a fan. I had this month alone, okay, over 500,000, 500,000 viewers who watched my videos, watched at least half of it. We've raised capital from TikTok and we've grown our following. Some of you are from that, and that's okay. That's great. I love it. But I share. It doesn't have to be anything long. Something fancy. It could be about something interesting in what's going on in the market, or something that's going on in a city, or a property, or a deal. Okay? Just get in the habit of sharing. Use your phone, save it, post it. 5 to 10 minutes a day is all you got to do to start seeing some impact. Okay? I'm a big believer in something called the marketing octagon. This is where we basically take one piece of content and reshare it across multiple channels. Photos, short videos, or stories do best. You can use buffer.com if you're too busy during the week. You can actually go ahead and pre-schedule things to go out across multiple platforms. Not everyone is on multiple platforms. That's why we share more than just Facebook or more than just LinkedIn, is we share it everywhere. Okay? You never know who's going to see it and when they're going to see it, and cross promoting equals more hits. Best times to post are at lunchtime, 3 p.m., 7 p.m., and 9 p.m. Even every once in a while, early in the morning before 7 p.m., while people are getting up, getting ready, or doing their business while they're sitting on the toilet. Actually does pretty well before 9 a.m. too. Surprise, surprise. Okay. Start with one thing. Start with sharing something once a week and going to twice a week. If you are so busy doing everything else, you got a very hectic work schedule, take 5 minutes and share something. Go find an article and share it. Something on real estate. If you get a tape of assets, help you go over to PaperStack and pull a picture of one property and throw it on their hand. Look at this deal. It's something that everybody can do. It's not hard to do. Okay. All right. Moving on. Business structures are pretty simple on how you structure your business. You don't want to buy in your own name. Okay. You do need to use LLCs, trusts, S corps. Go get you an LLC. If you live in California, I'm sorry, you're going to pay $800 a year for the fair weather tax in California. Okay. I don't like to keep more than $1 million in asset values in a single entity. I actually prefer less in a lot of cases, but when you're buying smaller balance notes, you don't want to go buy a new LLC for every note you buy. Okay. We kind of have 3 or 4, but starting off with one when you're buying for yourself or partnering with somebody, that's good. But make sure that LLC is not attached to like your full-time business if you're doing something else. Okay. If we have somebody who's invest $250,000 or more, we'll use a separate entity. Okay, boo, back at you, Joe. We keep our individual deals and assets separate from partner deals, existing business. So, like if you're going to use the money you've got saved, Sylvia, keep that in one LLC. You're going to part with somebody else, put that deal in a separate LLC. Performing notes, if you take a property back and turns it into rental, keep your rental portfolio separate from your note business. Larger assets, like every commercial note, every $1 million plus asset has its own LLC because you're making enough money on it to pay for that fee. We have a separate marketing company. It's different from our investments. We also have a separate management company from the actual operations. Can I just use my self-directed IRA? Yes, you can use your self-directed IRA to do it, but if you're going to get mail from people like me, knowing that you have a self-directed IRA, and that's okay. The reason we use LLCs is asset protection. If something happens and you have a violation on the Consumer Finance Protection Bureau, Fair Debt Collection Practices, their fines start like at $50,000. So you might as well have an LLC. If you do get fined by something, it stops in the LLC and let the LLC go under and do something else. Okay. Some actual counties like Wayne County, Michigan are suing IRA trustees for back taxes. So like it may be one investor has an equity trust for the benefit of John Simmons is the investor. But what Wayne County is just going and suing equity trust because they're not getting paid taxes. So some of these companies out there requiring you to no longer fund in your IRA. They want you to fund in an IRA LLC. Okay. If you're using funding or joint venture partners or you're splitting deals, you want to definitely use some different LLCs, not just an IRA. Yes, you can go create a self-directed IRA LLC. It's about $1,500. give or take a little bit, where you have checkbook access. But most of the time, you don't need that. Most of the true self-directed IRA custodians out there can fund deals relatively quickly in a few days, as long as the paperwork's fine. So sometimes it's good, sometimes that's bad. Okay. Trusts are okay if you're buying stuff, but eventually, if you're going to foreclose or sell the asset, you're going to take it out of the trust. You might as well just keep it in LLC. Yeah. Some people use trust and they think that's right because it's just create a piece of paper and it's a trust. Okay. I get it. It's feasible, but banks are not using trusts to buy notes. Okay. They're using LLCs, entities, stuff like that. It's a cost of it's just a cost of doing business. It's a write-off. You need to document things. Having an LLC is not just a trip to the Secretary of State and getting a tax ID number from the IRS. You need to document transactions, whether it's contracts or funding agreements, offices you get, vendors you use, any partnerships, any leases. There's a variety of other things that you need to document, and that's why we like to use a company called Laughlin and Associates. They're out of Laughlin, Nevada. They've been around for 50 plus years, keeping LLCs up to date, their documents. Yes, if you're a single member LLC, you still need to document what the hell you're doing. So it's actually an LLC and not an individual. Okay. They help with asset protection, structuring. If you need an LLC for the note business, they can tell you exactly how to set all that stuff up and help you. You've also got a corporate veil protection plan that protects you. They'll reach out to you once a month to help you with your documentation and tracking of your entity. And they've got some great asset protection things. They're also great if you want to set up like a living trust and other asset protection. They do a biannual event called Magnify Your Wealth Summit in San Diego or Orlando. They've actually got an event coming up in Orlando here, I think in a month or two. Okay. FinCEN BOIR. I don't know what that means, Jefferson. What's FinCEN BOIR mean? But this is who we recommend. Affordable. Their team is phenomenal. We do a lot with Laughlin Associates. They probably do asset protection for 95% of our coaching students. Check it out. As a coaching student too, you also will get often a free ticket or a very, 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 very cheaply discounted ticket to the Magnify Your Wealth Summit. It's well worth going to. Great place for networking. Usually it's about 125, 150 people at, but it's a great place to raise capital. Oh, yeah. You got to do a beneficial owner. Okay. Business owners now. Yeah. Woo. There you go. Good stuff. All right. Check it out, corpveilprotection.com for what they offer. Okay. Let's go ahead and I'll pause the recording right now. All right. So we've gone through how to fund, kind of a little bit how to structure some stuff. How do you make money with this stuff? And that kind of goes into exit strategies, the different exit strategies involved when you're buying specifically non-performing notes. Performing notes, guess what? They keep paying or they pay off. Okay. Non-performing can get a little trickier sometimes, not in a bad way, because you're buying it a whole lot cheaper because it's non-performing. But there's basically 10 ways to skin a note or make money in a note investing. We did a longer video on our channel, YouTube. Check it out. There's the link, bit.ly/note exit strategies. You can wholesale the note, which is like flipping contracts. You can wholesale notes all day long, just like you would real estate. But here's the thing. You're going to be making less on a wholesale deal than anybody else's. And if you're going to take all the time to go find you a wholesale buyer for that note, you might as well use that same marketing and same strategy to go find investors to fund your deals. But wholesale notes, you can make flat fee, $500, $1,000, 1 to 3% points. 1 to 3 points on it based on the funding amount. I mean, we'll wholesale stuff occasionally. If we're buying a portfolio and some of our students want to buy with us, that's fine. We'll just, hey, you're buying the note, you're going to pay us $1,000 flat fee on top of that for paperwork and transferring. Does notes that I foreclose on have ready period? I don't know what that means, Van. If you're wholesaling up first time, you may do a double closing where there's 2 contracts. If you get a contract from a bank, like you're buying it for yourself and you're going to flip it, you may want to redo the contract where it's going from you to them for the increased price. And they're closing a day or two sooner than you're closing with a bank to give you a little bit of buffer. Okay. If you trust the seller or the buyer, then just do a flat fee agreement. We do a flat fee agreement with most of our students, just like, hey, I trust you. You're buying the note from this person directly now. You can use a real estate attorney to set up escrow accounts, especially if you're using somebody else's money to fund the deal. Start off with, just go pay the $500 or $700 with an attorney to set up an escrow account. Good wholesalers, here's the thing. Good wholesalers know their deal and market it. They do their due diligence. They're evaluating the deals. This makes sense. Why is this such a good deal? If you're just trying to slap spaghetti against the wall, like you get an email from some person telling you about a deal and you're just like blasting it out to anybody, you're not really doing. You don't know what the hell you're looking at. You don't know what you're doing with. Is it a deal or not? It may be a dud, or maybe you're just burning bridges, sending crap out that you haven't evaluated to see if it's a deal or not. Okay. But after wholesaling, when you're buying up, to really the next strategy, the major one is that you try to get the bars to start paying. Okay. Bar starts reperforming and paying on time. You want to have a licensed servicer to help you out with this. They're the ones actually reaching out to the bar to get them back on track. They're collecting payments. They're doing right party contact. That's what RPC stands for, and calling them 4 times a month at business or their home. You instruct the servicer what you want. Hey, if the bar comes to the table, I want to start paying their monthly payment plus extra to get caught back up on. Do a forbearance agreement. Pay on time for 6 months, 12 months. We'll put what's left, what you're behind on the face amount of the loan. Okay. That's it. Loan modifications will be the next thing. They can't start paying their existing payment. Then you need to modify the loan in some sort of fashion. Maybe you do a trial payment plan first for the first 6 to 12 months, which is what I would recommend before you actually modify the terms of the loan. They could, do a payment plan with a lump sum or extra payments. You can do it for 6 or 12 months till they get back on track. It all depends on how far behind they are. But once you modify the loan, you can do a variety of things. Adjust the balance, forgive or reduce back payments, adjust the payments amounts, stair step it. You never want to go straight to a loan modification before 12 months, because the way the IRS tax it, if you modify before 12 months, it's considered a short-term capital gain. Okay. They don't care if you haven't collected 12 months of payments. They're just going to go and tax you as short-term capital gain. It's kind of like that forced tax on unrealized appreciation that they're talking about trying to do. It's a bunch of horseshit. Okay. Now, if you modify a loan too, it restarts a time frame for foreclosure. So if they were 6 months behind and you modify the loan, well, guess what? If they don't make a payment, but you've already modified the terms, you can't go back to the original terms. Now you got to wait another 90 days for the non-payment. So I never do a loan mod off the bat. It's always like, we're going to do a trial payment plan for 12 months or 6 months. At that time, once you do that payment plan, then we'll modify. Then we'll do some sort of modification. I'm not going to give you the bank if you're not going to work with me. You have to perform first. You haven't performed. Let's make sure that you can perform before we do anything. Okay. Oh, so the question that Van asked is, does notes that I foreclose on have a redemption period? That depends on the state, Van. Some states have a redemption period. Others don't. Like Minnesota, if you buy something in Minnesota, it's got a 1-year redemption period. You can't sell that property for a year. Same thing in Alabama. Alabama has a 1-year redemption period. Okay. Some are tax certificates and others are tax sales. So it's all a state-by-state basis. Now, like in Alabama, if it's a mortgage note, it's a 1-year redemption period. But if it's a contract for deed, you're evicting. It's not foreclosing. So it's a little bit, it's different with that stuff. So it's state-by-state basis. Okay. And we're not going to go through all the states. That's something you need to learn on yourself. That's part of your education and learning the markets. Okay. When we do a trial payment plan, we always have the borrower sign the trial payment plan, and definitely the loan modification docs. Your servicer can help you create this stuff. Okay. It's part of what you're paying them, the $95 or $35 a month. Okay. If they can't do a loan mod, we'll try to do a loan payoff. Borrower pays off the loan. Either does a reduced payoff if they owe a whole lot more than the property's worth. If we bought it at a big enough discount, we can reduce some. So if you can pay it off in 30 days, we'll give you a 25% discount. Paid off in 15, we'll give you, whatever. Or you're going to pay it over 90 days. Okay, you're going to do a third, a third, a third. Here's the thing. If that note has been, if the previous seller has been reporting to credit bureaus, they're not going to be able to go out and get a bank loan to refinance. It's just not going to happen, because if you have a mortgage late on your credit for 24 months, no bank is going to give you a loan. Now, if they go get a hard money loan and it's non-owner occupied, they maybe will get a hard money loan to lend it paid off. Okay. But, or an investor to buy it, that's different. But if it's a primary occupancy, they're not going to go to a traditional loan and get refinanced. The only exception would be if they're 62 or 65 plus and it's a reverse mortgage. That's the only thing that would do it. And, or maybe they've got money in a retirement account, 401k, that they could cash out to pay off the loan. Okay. Van, what's the minimum equity of the property I should look at to buy the note? Van, you need to focus. Please stay on track with what we're talking about right now. Okay. That's the important thing. Is equity is different. There should be, it all depends. Negative equity, some equity, that's a longer term stuff that we go through our 3-day. Okay. Appreciate these questions, but that's something that either make a phone call with me. It's all dependent on what strategy you're looking at. Okay. Me, I like negative equity because I get a bigger discount of those. Okay. If they're equity deals and I'm buying the note, I got to be able to buy that note where I'm going to see at least a $50,000 profit below payoff. Because remember, if I foreclose, I'm only entitled to payoff, not the value of the property. All right. But cash out the requirement to pay off on that strategy. You can also handle the payoff of the settlement with a servicer can help you out with that with a reduced payoff. Okay. Besides, if they can't pay it off, maybe they can have somebody that takes over the loan and you do a loan assumption for them. You can always allow somebody to assume the loan, a family member, uncle, aunt, niece, children, family member, potential investor. We always want to have the person taking over the payments fill out a new loan qualification form. We're not creating a new loan, not originating. They're taking over the existing one. That's why we don't need to have it go through a loan originator for that, because we're not doing a new loan. We're not refinancing. They're taking over the existing one, keeping the exact payments and terms of it. Okay. All right. The borrower can quick claim it to the new note payer at any time if they want to, but we always like, hey, if we're going to stop the foreclosure on this and you're taking over payments, who's taking over payments? Otherwise, we do have the right to enforce the due on sale clause if we want to. Short sale the property. You can always allow the borrower to short sale the property. No, Van, you can't. Okay, you can't do a subject to on a note. Okay, you could take over payments of somebody's loan, but you basically deed the property for you. Okay. Let's see here. Short sale property. Okay, so the borrower, this is where they owe more than the property's worth. We allow them to pay off the loan or sell the house on a short reduced settlement. Okay. We, the bank, has to approve the short, whatever we're taking off. So I'll give you an example. Say the borrower owes 150 grand. House is only worth 120. We, as the bank, can allow the lender to list the property for like 100, 110 to try to get it sold. So if it's 110, maybe it's 115 total. They owe 150, so we would allow them to basically sell it at a $35,000 short. Well, if we bought the note at 70, I don't care. I'm still making 40 grand. Okay. We are the third party has to prove the short. Big thing about this is list the property. You never want to have them list the property with an agent and not get any activity, especially listed at full value. No. We always tell the agents listed at 85% of fair market value in the MLS and say subject to third party approval. That's what they've got to do. If they list it at full value, they're not going to get any showings. Okay. If we list it at 85%, we should see some showings. Now, if we don't get any activity in the first 2 weeks of listing at 85%, then we say, no, we need to move to just doing a deed or a consented judgment. Okay. We don't allow them to book appointments around the borrower's schedule. I'm sorry. No, if we're going to do a short, you're going to have to be able to show that property in a given time. So you need to keep it clean. If you don't allow people to see it, then we're not going to allow you to stay in that property free and clear, or, without paying anything. We're just going to move to liquidate the property. And yes, you have the right to reduce the real estate commissions, realtor commissions to 4% of short sale if you want to. If no showings in 2 weeks, move to a deed in lieu, cash for keys. If there's a second mortgage on the property, you can move to a consent to judgment at that point. Okay. Now, part of the thing is here, you can 1099 that borrower for the short. They can write it off. You can write it off. Even if you send them a 1099, they don't have to pay taxes on it. They can go file as an IRS form 928, I believe, that's showing being insolvent. Okay. Deed in lieu, cash for keys, like this, we call this a friendly foreclosure. We'll let the borrower walk scot-free. The borrower deeds the property back to us as the bank. We then forgive the debt. normal cash or keys. We try to do as little as possible, but we'll do like $500 up to about even 10 grand if that's depending on the profit margin. Okay. The idea of doing this is so that we don't have to go through the longer foreclosure process. We can get the property back sooner than later. They have to get cash. They've got to make sure that the property is in good condition or clean swept. It helps them avoid a foreclosure on their credit that will hurt them for 7 years. Okay. Late pays will just be 2 years, but foreclosure, 7 year will hurt the credit. You also want to double check and pull title, make sure there's no other liens on the property. Because if you do cash or keys, those liens aren't getting wiped out. A foreclosure wipes out those liens. Okay. So you got to double check that. Never accept a deed in lieu if there's a big second on the property. So now we'll do consent to judgment at that point, or cash for consent. And what that is basically the borrower's consenting to the judgment on the first to help you wipe out. You don't have to collect on the judgment, just doing a consent to it so that you can take the property back. Because in most states, a lot of the states are basically what's called a one action state. It means the bank can do one action to collect upon what they're owed. And most of the time, that one action is the foreclosing on the property and taking the property. There are some states that will allow you to go after a deficiency judgment. If they owed 150 and you only collect 100 at the sale, then they could let you go back after. But those states, I just don't do that. It's just not worth my time. All right. If the borrower's willing to work with me and deed it over to it, then the spot, great. We'll forgive the debt, let you walk and move on. If you are buying a note in a state that has a rough time, longer foreclosure time frame, or you find out that they're not a friendly city like Chicago, if you're an out-of-state investor, if you've done some work on an asset, just sell it to somebody else. You've actually created value knowing which way the wind is going to blow. If the borrower is difficult or if it's an issue where it's a pretty clear set, just sell it. Especially when workouts or longer foreclosure timeframes with troubled borrowers, this is important. Many funds buy notes. They work to modify in 90 days. If the borrowers don't modify, I guess some sort of show plan in 90 days, they turn around and they try to sell those notes at a quick purchase, at a quick profit margin. Okay? Think about this. You buy a portfolio notes, if you can get the borrowers on track at 90 days and paying, that's good. But if you then don't and you sell notes at 10% markup of what you paid for them within 120 days, that's 10%. That's a 40% annualized return by doing that. Okay. If you need to sell, local investors, market via your local meetup, your groups, your networking events, talk to other, hey, do you have somebody here in the neck of the woods, Facebook, making a handyman special if it's an ugly ass property or something like that. Okay. Your investor-friendly realtors are worth their weight in gold. I don't tell you not to work with agents. You need to work with agents. You are not the expert. Hire experts, okay? Number 9, foreclosure happens. It just is what it is. It happens a chunk of the time. You have to be prepared to do that. Non-judicial foreclosures like Texas, Georgia, they're faster, cheaper. It starts at $1,000. Judicial foreclosures, that's going through a foreclosure process. Yes, you've got to hire a real estate attorney that's licensed in the state to do that. That can start as little as $2,500 more. Sometimes when you're buying notes on judicial foreclosures, the previous seller may have already paid a big chunk of the attorney fees. That can work in your favor too. Okay. We'll try to sell it at the foreclosure auction. So we'll have the attorney who's foreclosing, we'll tell them like, hey, we're willing for you to go up to this. So if it's worth 120, they owe 150, but it's only worth 120. It makes no sense for us to list the sales price at 150 at the auction unless we actually want to take the property back. Okay. But I don't necessarily want to take the property back to do more rehab and then list it. So we may sell them like 80 cents of the dollar. So if it's worth 120 at 80, it would be listing it at what was that? 96,000, right? As is a value and payoff. Okay. If not sold, if it doesn't sell at the auction, guess what? Then you're taking the property back as an REO and you need to clean it up, evict, and then sell it off. Okay. But the foreclosure basically cleans the title, wipes it clean. That's if it foreclosed, then you got to know what's the redemption period. In some states, it's 6 months, some it's 12, some there's no redemption period. It just varies state by state. Okay. If you take it back, if you do take the property back, do yourself a favor, place a lien on the property to protect your equity. So, like example, if I took a property back and it's worth 150, and I borrowed 50K from an investor to buy the note, I'm going to put a $50,000 lien on the property in the first lien position. I'm going to have my attorney slap another lien for $100,000 to protect the equity. Why? Because if I hire a contractor and they come and do a shitty job, or somebody tries to throw a fraudulent lien on the property, they're going to be in a third lien position. I can have my attorney just do a friendly foreclosure, wipe out any third lien, not the first lien, but it wipes out any fraudulent liens. It's happened. I've had people go and slap liens on foreclosures, and then we had to work to get those taken off, which can take 90, 120 days or longer to wipe out those fraudulent liens. Okay. If you've got the borrower back on track and they started paying on time for a period of time, 12, 18 months, whatever, it's a reperforming note. You can sell it. Sell it at an increased price. So if you say they brought some money to the table, they've made 6 to 12 months of on-time payments, it's really considered a reperforming note. But you need to have that with a licensed servicing company. It adds value. That little 35 or 50 bucks a month you're paying to them, it adds value having a third party. Now, you can only sell that new note off of the base P&I payment. If you have it, doing a trial payment plan for a short period of time, and they're making $600 a month payment for 6 months, and after 6 months it drops down to $400 again, you can't sell off the $600 a month. Sell off the $400. You're probably likely going to be able to sell it somewhere between 80 and 95% of the unpaid balance or value, not the legal balance. If they owe more than the property's worth, you're not going to be able to sell it at that. So be smart. Don't be greedy. It'd be great if you could sell it above what is owed, but that doesn't work that way. Okay. Like somebody's trying to sell a performing note, which was at 14%. They're going to sell it at 11 yield. I'm like, so I'm going to pay more than the actual balance of the note? That makes no sense. Your balance of the note's 100. You want me to pay 110 for that? No, that's not how this works, idiot. Okay. How do I handle, is that the tax on note REO sale, or is that what you're supposed to be, DeWinder? I'm not. So basically, if you sell, I think you're saying, how do you handle taxes on? Well, you hire an accountant or bookkeeper for you. So if you foreclose and then sell the property off in less than a year, it's considered a short-term capital gains. You're going to pay capital gains taxes on that short-term. This is why most of our deals are at least going to be 12 months or longer. 12 months in a day saves you a whole lot of taxes, because then it's a long-term capital gains tax, which is much cheaper. Of course, if you forgave 35 grand and your profit's 35 grand, guess what? 1099 that 35 grand to offset your profit. Does that make sense? So while notes don't necessarily have like depreciation or cost segregation on the note side, they do if you end up foreclosing and taking the property back. You can use that. If you sell a note off, okay, or you foreclose and sell it at auction, 1099, or you do a loan mod forgiveness. Here's the thing. I don't like chasing deficiency judgments. If I have a bad tenant, okay, if we've got a renter in it and they haven't paid the rent and they move down, I don't go after them for back rent. Yes, you should still file that with the county so it shows up on their credit. But I 1099 them for the lost rent and any damages. Why? Because they can pay taxes on it. It becomes an immediate write-off for me versus me trying to chase it. They can go pay taxes, Uncle Sam, on that. And it's funny because a lot of people don't think about, I'm going to try to chase a deficiency. It's not going to work for you. Not worth it. Just 1099 them, send them a 1099 and be happy and move on. Okay. So a borrower may still be behind. Like some of these places, some of these borrowers we borrow where they were like 2-3 years behind. We worked out a modification, a trial payment plan. Well, they paid on time for 6 to 12 months. Great. We're just going to do a forbearance and put the rest of it on the face amount of loan. So it's going to extend the loan for another 12 months, but you're basically paying on time again. Okay. That's a beautiful thing. Okay. Bankruptcy still happens. Bankruptcy, we kind of put as a different category. Bankruptcy is either going to turn into, it's going to be either a chapter 13 or a chapter 7 on the residential side. I like bankruptcies because now you have an attorney to talk to. Yes, you need to have a separate bankruptcy attorney to represent you in front of the courts. A BK chapter 13 is basically going to be a restructuring. They should be paying you their monthly payment in a BK chapter 13 payment plan. The court will give them basically to come up with a plan, a payment plan over 60 months. Sometimes it's less. They need to be paying. They'll be paying their underlying base payment plus an amount off the back payments. Okay. When you see a note, it should say BK is one of the spreadsheet columns. So BK Chapter 13. Then you want to go to pacer.gov to look at the bankruptcy report because it's got all the due diligence you need. So usually a BK Chapter 13 will be a 5-year or less payment stream. So it's like buying a performing note. If the payment plan to come back doesn't make any sense or just is so small, you have the right to not approve the payment plan and have the BK dismissed or discharged. If they don't pay it, just have it discharged. Now, performing BK Chapter 13s are sought after by a lot of Wall Street firms, and they'll pay 80 to 90% of the unpaid balance for these BK Chapter 13s. Like I said, the plan fails, you discharge, kick out the BK, and then finish the foreclosure. Okay. On Chapter 7, liquidation debt doesn't mean they get to keep the property. It's what some people think. Oh, we're liquidating that, we get to keep the property. No. You don't. We're going to foreclose. You can either give the property back in a deed in lieu, or we're going to finish the foreclosure. You don't get to stay in the property. Okay. It becomes an REO after you foreclose. You sell it at auction, stuff like that. That's what people don't know. Okay. Deed in lieu or foreclose, the bar does not comply with what the court says. Okay. That's the exit strategies. All right. Now let's dive into, are these a deal or duds? Some of the things you need to keep in mind when it comes to looking at this stuff. Okay. Because there's a lot more things versus just looking at the value of the property. All right. But you'll find some amazing deals by looking at things to consider before buying. One of the things that we get access to that we ask for due diligence is the servicing notes. What's the notes with the borrower and the servicing company? Are they calling in? Is they being aggressive? Have they asked for a loan mod? What are they trying to do? You look at payment history. Sometimes they haven't paid in the last 6 months. Why have they last paid? Oh, they lost their job. Okay, well, they're getting hired back again. Okay, they'll probably get back on track. Okay, look at market values. Are they steady? Are they increasing? Are they falling? Days on market. Is it less than 180 days? Okay, that's not bad. If it's longer than 6 months, you got to worry about that. The value is probably going to reduce the value. You're not going to get inside access to a lot of these properties that are occupied, but since they're occupied, they probably have less repairs needed. Yes, you're always going to have to fix the toilet paper holder in a restroom. You're going to have to probably put some paint and carpet in. It's just going to happen. But if it's occupied, the AC is probably still kicking. The copper's still there. The goblins haven't showed up. If it's in a place that gets cold during the winter, you don't have an indoor skating rink. Okay. Look at your foreclosure timeframes. The longer foreclosure states, cheaper pricing. The shorter, you pay a little bit more. Look at the neighborhood. Is it in a good area? Is it a rough area? Okay. Is it near something? Is it the only residential in an area? Is it back up next to a railroad track or a nuclear power plant? Okay. You can check out zoning violations or issues. Reach out to the zoning department. Hey, does this have any issues? Okay. Look at city government issues. Like here in Austin, Texas, we got I won't say corrupt, but pretty bad city council. So am I buying a house next to a hotel, or are they trying to convert the hotel to a homeless shelter? You know what I mean? Or like in Portland, do they enforce crime? No, they don't. Okay, I don't want to buy there. What's the crime map look like? Is it a good area? Is it a rough area? Look at the size and population of the city. Is the city that you're buying, is it near a major city? Okay, or is it way the heck out in the middle of nowhere? Look at the exterior. That's why I always put eyes on the asset. They look at least 3 sides, maybe behind it. Is the grass tall? Is it look nice? Is the siding falling off? Okay. Rural location. How rural? Does anybody want something like we were looking at this one outside of Anderson? It was in a pre-rural town of 3,500 people. For most people, it's too small. But that's literally like a 5-minute drive from Anderson, Indiana, which is pretty good size. When I talked to my agent, he's like, "Oh no, that's a good city, good to buy in." Stuff is moving there because it's close enough to a major city that it makes sense. So, okay, most people wouldn't do that deal. I would do that deal. There's also local colleges. It doesn't have to be a huge college, but local colleges means if worst case you take the property back, you could probably turn it as rental. Like last night, there's this little town called Belton, about 3,500 people. University of Mary Hardin Baylor's there. It's a beautiful little city. I'd buy there all day long. Okay. I know that area. It's pretty. It's small, but hey, it's moving. It's on the path of growth for Austin, Texas, basically. Okay. You also got to understand, does the asset meet your strategy? What do you want to accomplish? Okay. Is it you're looking for cash flow so that you can buy that note and get it either reperforming, or if it's a reperforming note, it's going to stay performing for you. Are you looking for larger checks? So that would be something that you would buy that non-performing note and either get a deed in lieu, cash for key, or you have to foreclose and sell it as an REO. Are you wanting to keep assets and have asset growth? And so you're buying these notes that if you foreclose, you don't mind holding on to them and turn them in a rental portfolio or selling on a new note origination. Yeah, I don't like that last part, but that's some people do. You want to avoid weird assets and unfinished projects. I can't tell you how important that is. Don't buy, when you're buying loans from a hard money lender, you want to make damn sure that property's finished. I've had people buy notes where the exterior looks good, and when they get down to it, it's a shell on the inside. Okay. Does the asset have really three profitable strategies? Those three property strategies, it's non-performing. Will it be a good yield if they get reperforming? Does it make sense to do a deed in lieu cash for keys in 90 days or less? That's awesome. Must be, it's a must. Or if we have to foreclose and it takes a full 12 or 24 months, is it still going to be a good yield in that time frame? I mean, you don't have a crystal ball 24 months from now, but you can kind of see trends. Values going up, staying same, or going down. Okay. Rental, some people want to turn stuff into Airbnb, short-term rentals. That's fine. That's not me. I want to stay in my lane. I don't want to try to mixing 3 or 4 different strategies. Keep it simple, ladies and gentlemen. I don't want to originate new notes. Okay, because oftentimes, if you're going to originate it, you're going to tie up all that equity in a property, unless you've owned it for 90 days, and you get a bank that'll let you do a cash out, then you put your capital. It might make sense at that point. But for the most part, no, it doesn't. You're tied up all that equity, and if you want to try to sell that note off, it's not going to give you the price. It would make more sense for you most of the time just to turn around and sell it as an REO. Okay? You can't sell it as an REO. It's not going to be a good deal. Shouldn't have done to begin with. Okay? Something you always want to worry about too is legal started. Ask to speak to the attorney, or ask to get some sort of update from the attorney on where they're at in the foreclosure process. Look at the servicing note, the collateral file. Look for hardship letters, background of the borrower. Look at the financial statements the borrower should have provided. Check the bankruptcy if it's on BK by going to pacer.gov. Everybody that files bankruptcy has to fill out like a 9-page bankruptcy disclosure statement, which shows values, debts owed, money and savings, 401ks, all that good stuff. Look at the state's statute of limitations for payments. Some states have a long time frame for statute of limitations of payments, where if the bank hasn't tried to collect in 10 years, they can't collect. Or if maybe it's a 4-year statute of limitation, if you haven't tried to collect in 6 years, guess what? You're saying goodbye to the 2 oldest years, and you're only able to collect in the last 4. Some states like Florida have something called safe harbor, which is good. Basically, if you buy the note and foreclose, and there's a big HOA or condo association lien on it, which a lot of these do, those get wiped out except for either 1 year of HOA fees or 1% of the original sales price. So you got to know, got to buy the note before the judgment's filed. Okay. Colorado has something like that. Nevada has something like that for HOAs. Okay. But that's important. Very important. Bought a lot of stuff in Florida. And I make sure, where are they at in the process? Oh, can I be substituted as the plaintiff? I don't want to buy the judgment. If you're buying the judgment, then you don't get safe harbor. So it's important to do. I had one attorney screw that up. Didn't transfer it until after the judgment, and the HOA wanted to fight me on safe harbor. Okay. Make sense so far, everybody? Good. Good. All right, let's dive into some more of the due diligence stuff. That this will probably answer some of the questions you have. All right, before we dive into Sylvia had some issues. I met Alex Johnson at an online meetup. I don't know who Alex is, but anyway, when I mentioned investing in the second position, he pointed me in your direction. I'm glad he did. I have a lot to think about. You do, Sylvia, but here's the thing. I'm not here to waste your time. I don't want you to waste your time. All the things that we're talking about here is good stuff for you to learn, right? Whether it's first or second. Seconds have more due diligence, because not only are you doing due diligence on the bar or the property, everything, you also got to do due diligence on the first lien holder and pulling credit scores and all that stuff. We don't pull credit scores on first liens because it doesn't matter. We're in the first lien position. I don't care if you get a second, you're not paying. I'm going to wipe them out. Okay. You can raise capital. Okay. You are capable of raising capital. I mean, if you're a deputy It's a whole lot riskier for you making a traffic stop than talking to an investor about funding your deal. Thank you for being a police officer, okay? But you risk a whole lot more day in, day out by putting on that badge than you would ever do with talking to an investor about funding your deal. You have a whole different level of credibility than others do. So embrace that. Understand that, okay? It's not hard. This is not rocket science. You have the goal. He who or she who has the goal makes the rules. All right, let's dive into some more due diligence stuff here. All right, so new due diligence stuff, the borrower of the property and the collateral. Okay, you're going to learn more by going through a deal the first time around. If you want to look at a deal and start evaluating and doing a little due diligence, go over to PaperStack, pull one of their 20 non-performing notes and start looking at things, looking at the stuff. Go into county records, checking who the borrower is, Googling the borrower, see if you can't find them on LinkedIn, social media. There's a whole lot of stuff you can find. Pull values in the property. Okay, longer due diligence videos, note due diligence.com there. If you go to my YouTube channel, you'll see us going through due diligence on breaking down tapes. There's 15, 67, 300 plus notes, all sorts of due diligence, especially some of the individual like case studies that we've posted on there. We did one in Austin recently. We did one in Round Rock. We did one in Indiana. We did a whole variety of different deals that we've broken down the due diligence and kind of walked you through. Okay. But what you're going to get a spreadsheet. Okay. You're getting a spreadsheet and you got to kind of look at that stuff and pay some time, pay attention to that. But the first thing is you look at the borrower, you know, look at the servicing as we talked about. Have they been responsive? Have they been a pain in the ass? Have they threatened to sue or whatever, yelled at the borrower? Have they been, called in? Has been inbound calls versus outbound? Look at the loan documents, what they do beforehand, their loan application, they in bankruptcy. These are all good things to tell you about that. Go to whitepages.com or spokeo.com, do a search, quick skip trace to see where they live at. All that good stuff. We'll use VAs to do due diligence, but what happens, you got to realize it's not that hard to do. Okay. You need to understand doing due diligence at first because you're not going to do due diligence on 285 assets. You're going to get rid of a big chunk of those based on the states you don't buy in, the values, the numbers. That's going to reduce it down. That's the first thing you're going to see me do on these videos of going through tapes is I slice and dice, get rid of what the hell I don't want. Low monthly payments, low values, states. They're only 60 days behind, not 120 days. Get rid of them. Or high values I don't want. Okay, areas I don't want. I get rid of that, then we do a deeper dive. Okay? And you're not going to pay for due diligence until you have a contract. By paying for due diligence, you're not going to pay for a BPO or an external drive-by until you actually have the property under contract. You're going to rely on Zillow, Trulia to pull your values initially, make your offers, and then if your offer is accepted, then you're going to have time to perform due diligence. A week, 30 days, it varies by seller, it varies by condition of the property, okay? We do you do a deeper dive on the offers that are accepted. Because here's the thing. If you do all the due diligence on one asset and then make an offer, and that's the only offer that you're making an offer on, it's probably not going to get it. And somebody else bids better than you, guess what? You did all that work for nothing. I like kind of doing a quick review, knowing if I make more offers, I'm more likely to get something accepted. Because if they've got values on their spreadsheet, then I kind of have to go by their values as long as they're current. All right. So I'll do a quick due diligence, look at taxes, quick conditions, online values, online photos, run some formulas, and make offers. Knowing that, okay, if I make 50 offers and I get 10 accepted, then I'll do a deeper dive on those 10, and I can still kick those out if the value comes back less, or it's a shittier asset than what looks online, or the comps are way off. You know what I mean? People get all bent out of shape about trying to do everything on everything. No. 90% of what you're looking at, you're not going to ever bid on. It just doesn't make any sense for you. Okay. Look at social media of the bar. We have found the bars where they were self-employed and out of work. Like I just saw that one. There's another one where the borrower came back and was getting breast implants. He was getting breast implants. He was going through a transition. Or another guy was self-employed. He broke his leg, was out of work for 6 months. Okay, I can work with that. Okay. We use white pages to see if we can find family members and their social media profiles. We actually found a picture of a property by looking at a Facebook profile, and they're taking a family photo. We also found another one, a lady who's a borrower, who said in notes when the servicer called her that she didn't have any money. Well, we went to Facebook and found out she just bought a brand new Cadillac, wearing all these fancy clothes. I'm like, you got money, girl. You just want to give it to us. So when I called, she claimed that she was poor. I said, well, that's a brand new caddy you just all bragged about buying, and your brand new Louis Vuitton purse. No, girl, we are not going to play this game. This is your come to Jesus meeting, and I'm Jesus. So you can either get your 6 months of payments to me in the next 30 days, or we are going to foreclose. Homie, don't play that. Okay? Sometimes you got to put people in their place. Look at past and present employers. Are they working? You know, are they not working? The property. This should be pretty commonplace for you. Look at values online versus in person, as is versus 30 days. Okay. Always put eyes on the property, but you don't need to initially. But before you fund, after your bid's accepted, yes, send somebody out to take a look at it. There are vendors out there to help you out with it. We'll talk about that later on. Look at the exterior conditions. We tell a lot about exterior versus, you know, they have like a flag flying. Is there landscaping? Cars in the driveway, okay? Are the blinds look nice? You know what I mean? One of the things we try to look at is, if we're doing a drive-by, is see if we can see the meter. Is they have the glass ball for the electric meter on or is it off? We call the city as well. Hey, is power on or off? Okay. Look at nearby comps, sales. How long do those take place? Are they similar comps? You know, what kind of condition are they in? You know, broker price opinion may cost you, you know, 85 to 100 bucks for a third-party vendor. If you've got a local realtor that you trust, have them pull a CMA, comparative market analysis, off their MLS and then drive by. For you can also have another agent pull what's kind of like an AVM, an automated valuation model, using NARRPR.com. That's National Association of Realtors Real Property Report.com. It's tied into different MLSs, and it's a good automated value if you get worst case. Okay, look at taxes owed. Contact the county to see if there's any pending tax sales. Call the code enforcement department. Any liens? Like I said, look at the neighbor activity. Call the cops. What kind of crime is going on? Heck, jump on next door. See what's going on in that neighborhood. See if the properties ever listed previously from MLS or rental posting. We found one that the property is listed for rental 2 months ago. Okay, so we got all these interior photos. Look at rent rates of the property. Does it make sense? What's going on? Like the one case that we just did on this one in Austin. Was it last week I did it? Last Monday? Or maybe it was the week before. You know, I could see all these interior photos of the rental. But they tried to rent it for $2,500 a month. Well, their P&I payment's $4,000. Like, well, you're not, that doesn't make any sense, right? Are there any HOA or COA limitations? Like if it's in Florida, is it like down in the villages where it's like 55 plus? Okay. Does it have to be owner occupant? You can't have any rentals in there. There's some things. Is it a condo association? Is there any, what do you call that? Oh my gosh, special assessments they're going to be paying. You know, there's been some condos, high-end condos that had like a 6-figure special assessment attached to it. That's not fun. Okay. And then, like I said, crime map definitely. Is it a good area, bad area? You know, is it Aurora, Colorado with Venezuelan gangs? Probably don't want to buy in that area right now. You know what I mean? More about the property. You will not get internal access most of the time unless the property's been listed for sale or is listed for sale. That's good. But if it's not listed for sale, you're not going to go knock on the door. Can I see inside? Doesn't work that way. If it's vacant, the power's off, send a realtor out, peek in the windows. You can often tell that way. Walk around. Okay. If there's properties in Texas here, if it's like within an hour or two, I'll go drive by it. If I'm going to be investing in, I'll make the drive to Houston and look at 2 or 3 assets, or San Antonio. Sometimes I go up to Dallas and drive around and get properties. If I got a weekend, why not? I'm going to learn more about it. There's been times I've literally flown across the country and spent a week driving around. We've done that before. We've flown into Jacksonville, Florida, drove down the coast, looked at, you know, all the way down the coast, Orlando, all the way down to Key West, back up through Fort Myers, Cape Coral, all the way up to Tampa, Indian Rocks Beach, and looked at 50, 60 assets in a week. We've done the same thing flying into Michigan, flew to Detroit, Looked at everything about Detroit up to Bay City, all the way across to Jackson, Ann Arbor. Looked at 55 properties in 2.5 days. Did the same thing in Ohio. Flew into Cincinnati and drove all around the state for a week looking at assets. You learn more about that stuff. It's a write-off. Drive by an asset, you can learn what's it look like with pride of ownership. It's a great thing. Okay, great thing to do. All right, one of the things that we like to do, especially with our 3-day class, always give you guys an actual tape to review, tape to dive into. In the class that we have in a month, we've got a tape of these 285 assets that you can take a look at. Okay, we'll go through it briefly here before we wrap up today too. Use Zillow values for upfront due diligence, but order a BPO or of your own. Do it once you get it under contract or your offer's approved. Okay. This is a free tool for all realtors, narrpr.com. Okay. Call the utility departments. You are represent the bank technically, so they'll tell you more information than they would just somebody call about the property. So like I'll call the utility departments. Hey, I'm so-and-so with, I represent the lender. Maybe not the actual lender, but I'm technically becoming the lender. I'm calling to find out if property's on this property, if there's any outstanding balance on this. We're trying to make sure that you guys get paid when we foreclose. Oh, yeah. Can you tell me if it's the same name on it that's been on it for the last 4 years? I don't need to just say if service changed. Nope. Okay. Oh, power's off. Yeah, some of these counties like, oh yeah, they were in here yesterday. They're on a payment plan. Or, oh no, they got in a fight in the lobby. Okay, thank you very much. But since you're the lender, you have a vested interest in this property. They'll give you more information than they would just somebody calling. Okay. If the value comes back low, you reduce, fade your bid, move on. Okay. If they accept it, great. If they don't, then move on to other ones. Always, always, always put eyes on asset. Do not trust the seller. Okay. I've seen sellers put like 3 different BPOs in a loan file by mistake, and they went off the one that was the highest that didn't make any sense. The comps were even close. Okay. Or they say, oh, it's in good condition. This is one major seller did this out of Dallas to one of my students. Oh, yeah, that property's in great condition. Well, he bought the note without seeing it or sending somebody out. The whole front deck was caving in. Okay, all the decks in the back were caving. I'm like, are you serious? I'm like, trust but verify. Okay, always verify. The collateral due diligence, you want to make sure they're, you're only going to have the copies initially, a PDF copy, but once you close and you get the original, but always make sure you've got the original loan documents or the mortgage, that there's an assignment chain of title. Basically, every time that note's been sold, there needs to be an assignment of mortgage for every time it's sold. Okay. And every time it's been sold, it needs to make sure there's something called an allonge, which is a 1-page endorsement. It's not notarized like an assignment is, but for every assignment, there should be an allonge. An allonge is just like you sign the back of a check. Okay. What used to happen when banks originated loans, when they would sold that loan, they would just endorse the back of the mortgage on the back page and give it to a new seller. Well, with all the banks and things like that, banks don't hold on to the original copies in their office to sign, so they create a 1-page allonge which transfers that endorsement. Okay. Obviously, deed of trust makes sense. Or on the deed makes sense if you're buying the contract for deed that it's actually the seller that you're buying it from on that. If there's a previous appraisal out there, take a look at that. You never want to accept a BPO that's older than 90 days. Look at the loan application if they got financials or 1003s. If it's from a bank or institution, it's something called a 1003 file. Shows all what the borrower filled out in the loan application when applying for the loan. And after you close, that's when you'll get the actual physical hard collateral file. Make sure they have everything. Check your documents off, check them off, and good to go. Now, you'll maybe get servicing notes. There's other things that we've seen in collateral files that showed up afterwards that we didn't see in the soft file, like insurance checks that were uncashed, or keys to the property, or other photos, or hardship letters, or the borrower signed over the property via deed in lieu and the lender didn't know about it. So when we got the loan file, there's a signed deed in lieu sitting on top. We're like, yay, Christmas came early. Okay. All right. Questions about that? I mean, you're going to look at more deals. You're going to get better at it. Part of the 3-day class is going through that, spend a little bit each day going through due diligence. I always recommend people reach out to me if they got a deal they're making an offer on. Let's go through it your first couple times, making sure because my eyes will see things that are differently from yours. Okay. but you can learn more by going through and evaluating what are the taxes of. What's it look like? Is it a good deal? Can I buy this at a price that makes sense? If they start paying on time, what's my rough yield going to be? You know what I mean? Because here's the thing, this business, as I've said before, is a very vendor-driven business, okay? You need a team of vendors to help you. Your trusted team is a servicing company. I mean, we work with 2, 3, 4 different servicing companies right now, depending on what we're buying and who we're buying from. Massive Management is one you can use. They're out of Reno, Nevada. Allied Servicing's out of Washington State. Covey Financial's out of San Antonio, Texas. Covey really wants you to have probably 20 notes or more. They'll work with you as you grow, but don't call them for just the first note. They're very busy. They'd rather work with somebody who's got a growing portfolio. SN Servicing is probably the most expensive, but they'll work with one-offs. There's a whole lot. Title company for O&E reports. An O&E report is an ownership and encumbrance report. There's specific companies you can order these from. It's called like a 2-owner search. You don't need to go back to title when the property is created. You just need to go back to the current owner and the previous owner of you buying that note. Because that's why I like buying institutional debt. Okay? Because 99.9% of the time, for the bank to make the loan, the note that I'm buying, the bank or the lender that made the loan, it had to have clear title up to that point. So I don't need to really go back further 20 years to when the property was built to look at that title. I just need to go back to that owner and the previous one to make sure. If you're doing owner finance or contract for deeds, there's going to be probably outstanding liens available that you got to expect to clear up or do something with. Okay. Baldwin Advisory Group is who we use to help us with our O&E reports, the title updates. We also use them for BPOs. Pro Title USA is another company. They do a lot of the big FHA stuff, but they kind of, I don't know, they're big on the high end stuff, but they end up tending to miss the smaller stuff. So I just recommend Baldwin Advisory Group. You're going to need a valuation BPO company. Like I said, Baldwin Advisory Group is good. Foreclosure attorneys, so your servicing companies will have some. If you need somebody, let me know. Reach out to me. I'm always glad to refer or talk to people in my Facebook group who they're using. Usually many of your servicing companies will have their own list. I like to talk to the attorneys directly. Some servicing companies want to filter, like FCI doesn't want you to talk to the attorney. They want everything to go through them, and that can be costly because they're not very fast about responding. If you need to find somebody, legalleague100.com is a great place to go to initially look at some stuff. Besides just real estate, look for a legal team there. But the best thing is either referrals from your investors or your servicing company. Sometimes people will hire special servicing companies. These are more aggressive workout teams. We've hired people from servicing companies to be our special servicing where they're literally contacting the borrowers themselves. I wouldn't recommend you reach out. Some of us like, oh, I want to have the talks conversations. No, you don't. Put it with a servicing company. Tell the servicing company what you want. Because here's the thing. A borrower will play you against each other. If you're talking to them and they're talking to servicing company, talking to attorney, guess what? They're going to say he said, she said, and it just delays things. So do not talk to the borrowers. Tell the servicing company what you want or tell the attorney what you want and let that be the one main point. Once you go to foreclosure, you can always stop it if the borrower comes to the table or suspend it. But if the borrower doesn't come to the table in your first 30 to 90 days, once you buy the note, put it with an attorney and let them start the foreclosure process and then make all contact go to the attorney. Okay. Or have your servicing company say, well, we're no longer accepting payments. You got to contact the attorney for a workout. Okay. Singer Law Group's still doing some stuff, but they're a little bit different. I need to update that. He just merged with a new company. There are a few other aggressive loan workout companies. We'll talk. If you need somebody like that, let me know. We'd like to go through it. Okay. You need a collateral review guy or gal and a storage company. If you start getting a lot of files, your collateral file is what you're buying. Okay. Your file folder. This is technically what you are buying right here, ladies and gentlemen. This is what you're buying, not the property. This is mightier than the property. This secures your investment right here. So you do not want little Johnny or little Sally Sue to use this for drawing paper. You don't want to use this as a litter box. You don't want your dog to wipe his ass with this file. This is what you need. This is an old file that's been closed out for years, okay? But I hold it right here so you can see this is actually what you're technically buying. This is what's going to show up in 30 to 45 days after you close on the notes purchase. Okay. You start buying enough of those, you need to store those somewhere safe. I store them in a self-storage unit on the 4th floor. climate controlled. Okay. I can go over and get it, stuff like that. Other times, like if I'm foreclosed and I got to send the collateral file to the attorney to hold. Sometimes your servicing companies will store it. Okay. As far as collateral review, our buddy Joel Markovitz does a really good job reviewing it. There's a company called CSC out of Dallas that will review your files for you too. They're okay. Richmond Monroe will review your collateral files, tell you what's missing. They'll go out and fix it for you if there's an assignment missing or a launch. Right. I like to look at it ahead of time. So they're not too bad. They're out of West Branson, Missouri. Okay. Realtors should go unsaid. You need realtors to pull values, to drive by, give you opinions. When I talk to an agent, like, listen, I'm buying the note. We expect to foreclose. Would you be willing to do me a quick CMA? You'll be my listing agent when I'm done. It may be 6 months before I come back to you on this, but most of the time they're pretty handy. If they won't, then move on to somebody else. Okay. Realtor.com, ActiveRain.com. You can find some realtors there. Actually, Dickie Baldwin has a whole vendor list of realtors that are investor friendly, easy to work with. Okay. Property insurance. You're going to need a Forest Place Insurance Company, Ross Diversified, National REA Group, US Lloyd's, US Risk, a couple companies that we recommend, property preservation companies to go in and winterize it in cold areas. Your realtor should have somebody like that. Baldwin Advisory Group also has something like that. And so we've talked about Baldwin several times. That's who you should do. Let me just give you their website so you can go there. Dickie Baldwin's been a friend of mine. I don't know. I've known Dickie over 10 years now. But BaldwinAdvisoryGroup.com. He's out of Houston, Texas, but he does stuff all across the country. Really, it's your one stop. If you need something done as a vendor, check with Dickie or check with me, and you'll be good to go. First, seconds. Okay. He's done a great job. Dickie's been in real estate for over 40 or 50 years. Just absolutely phenomenal. Okay. All right. And that's it for the due diligence. Any questions about that? All right. Let's move on. We're just about done, guys. You need to watch your college football or your Labor Day weekend. So what comes next? I know I've gone through a lot here in the last 3 hours, almost exactly, for you today. You're not going to learn everything from note investing. This is meant just to help you kind of get your feet wet, understand. Look, there's a lot of moving parts to notes. There's a lot of moving parts to any type of real estate deal. All right. You can't learn notes from just taking a 3-hour class. You can learn a lot by taking a 3-day class, but still not everything you learn. You're going to learn most by doing your first deal, but you got to know what the hell you're doing so your first deal is a deal and not a dud. Okay. That's why we have our 3-day class, which is the #1 recommended class for note investing out there. We go more in depth in 3 days. It is not a pitch fest. Most of the time, it's me and maybe 1 or 2 vendors speaking for 3 days. A full first day on how to find deals. We go through all the different ways we find them, what we say, what we don't say. Much more intense we did here. A full day on marketing and raising capital and funding, going through the case studies, going through the script, going through the investor checklists. Okay? Showing you the case studies, showing the letters, pulling more lists for you. I mean, if you liked what we did in pulling 265 IRA investors in 5 minutes, then day 2 on the funding side will blow you away. And then the 3rd day is about exit strategies, how to flip, how to make money. Okay. How many deals does it take to master? It all depends on what you're focused on, Rami. You know, you're learning more in your first deal. You're learning more in your second deal. If you got somebody behind me, I mean, I'm a master of it and I've done thousands of deals. You don't need to do thousands, but we've helped students close 10, 15, 20 deals their first year. Okay. If you're focused on 1 or 2 states, it's going to be pretty easy to understand what's going on in that state. If you're buying in 5 or 6, it's a little bit different. Okay. It takes you doing on anything else. You know, it's what was it? Somebody said that it takes 10,000 hours of doing something to be a master of it. I don't think it takes 10,000 deals to do it, but you got to spend some time on it. And we're not talking spending 40 hours a week. 5 to 10 hours a week is what most of our students are doing. Okay. And that's why we have this split up into the find. It all starts with finding deals, then funding, and then the exit strategies of flip. How to make money, how to evaluate the deals, how to structure these deals makes a lot of sense. And, you know, our next class is the 27th through 29th, so it's a month from now. May change, may not, but I think it's going to stay there. But you get some bonuses. You get the replay to the April class that we taught. That's a $300 value. You're going to get a 4-week implementation coaching thing that we do the 4 weeks after the class. Every Wednesday or Thursday night, we will spend time with you for an hour, hour and a half, helping you implement more of the class. That's a $5.99 value. I don't know anybody else that does that, that throws that in. Usually you take a 3-day class and you get sign up for the $50,000 coaching. Yes, we have a coaching program, but our goal is we give you so much, we know it's going to saturate your mind, and you got to know, where the heck do I begin? So that's why we wrap up every 3-day class with the 10 things you need to do. And then the next 4 weeks is helping you put those 10, 15 things into place, working for you. Okay. That's included. Law and Associates includes an equity entity class on the secrets of entity and how to create this stuff, how to structure this stuff. That's $99 value. We will throw in our 1-day wholesaling and class, and then our calling banks class. It's 2 1-day classes on calling banks and wholesaling. Okay. We'll also tell you what, we'll throw in our due diligence class as a 1-day class as well for you. All right. We'll also throw in a 20-day series on how to find and fund. This is a video training series we did about a year or 2 ago. On every day for 20 days is 1 lesson on finding deals and 1 day or 1 session on funding. Those are the 2 things people struggle with the most. We'll give you a VIP ticket to Note Camp 2024. We'll have before the end of the year. That's included, and the replays. And you can bring a spouse or partner at no additional cost to our online class. Okay. All right. Now that's, and we'll also give you a note pool to bid on and work through. That's priceless. All right. All that's together, it's over $2,500 in extra bonuses, probably closer to $3,000, $4,000, but plenty of bonuses there for you. This is an online class, so you don't have to worry about jumping on a plane and flying, buying a hotel room, rental car, food. You can do this from the comfort of your own home. And we'll do it, run it usually from 9 to 5, my time, Friday, Saturday, and then Sunday is usually from 9 to 3. Take about an hour break for lunch on Friday and Saturday. Sunday, it runs straight through. And then you get the replays to the news class that you just sat through. So you can watch it again and again and again, plus a 200-page manual thrown in there with contracts, sample forms, case studies, all that stuff for you, so that you actually have like a business in a box and can go out and make deals happen. We have so many of our students, they take the class, they go out, they go buy their first note in the first 30 days. Like, oh my God, this is awesome. Okay. Now our Note Buying for Dummies class, if you go to notebuyingfordummies.com, very simple to do. This is what the website looks like. Notebuyingfordummies.com. There you go. Virtual note buying workshop. Okay. You go down here, click here to RSVP, put your information in there, click here to RSVP your spot. This will take you to the checkout page. Yes, it says $9.97 right here, virtual note buying workshop. If you go up here to the special code and type in all caps weekend, so that I know that you've taken my weekend class here, and hit apply, it drops the price in half to $498.50. I guarantee most of you probably learn more information in today's 1-day class than if you have taken somebody else's note training class, because you probably got pitched to death. Okay. I hate pitch fests. I want you to close deals. Not we talk notes, not we pitch notes, we close notes. So yes, you go to notebuyingfordummies.com and use the code weekend and apply. It should be $498.50. Now it shows you a different number on here. You probably put too many in the quantity. If you refresh your screen all the time, it's going to keep adding quantities. They go back and adjust the quantities. Okay. But that's how you get signed up for the class. All right. Easy. Normally $9.97. Today it's 50% off for you for watching our weekend class here, ladies and gentlemen. Yes, code weekend, all caps, to tune in. Now, if that's too expensive for you and you want to spread out your learning costs, we have a thing for you. We have our monthly membership. That's $97 a month. No, there's not a discount code on that. You've got to be a part of our WC membership for 6 months. You can't sign up for a month and cancel. You do, we're in charge your card for 6 months, okay? Because we just give you so much information. But we give you access to the class. We give you access to replays. It just makes it a lot cheaper for you for 6 months. Plus, you get some weekly coaching calls. On Mondays at noon my time, we do a live coaching call. It may be a case study, maybe a marketing thing, maybe a capital raising thing. It may just be breaking down deals, looking through assets. We have a separate base camp group for you guys. All right. But if you go to noteumbrella.com, you can sign up directly for the monthly membership at $97 a month. Look, we're going to keep note investing is something that's going to be, it's constantly tweaking a little bit. Different things happen. You got to be able to evaluate some things. Markets are changing. That's why we have the monthly membership. And guess what? This is not somebody else teaching it. It is me teaching this. Okay. Not some student, not some, telemarketer. It's literally me. Okay. Oh my gosh. Sylvia, you are right. I paid $3,000. I learned more smaller details from this weekend class. Oh, I'm so sorry you paid $3,000, Sylvia. Sorry. Well, you imagine what we offer in the 3-day class. Okay. But we also have one-on-one coaching, guys. I don't recommend that right off the bat. I think you guys need to go through the 3-day class, learn it. What's involved in our note coaching program is basically it's a 6-month to 1-year program. Okay. So basically when people go through our 3-day class and they sign up for our one-on-one coaching, what we do is this is completely customizable for your strengths and weaknesses. So everybody's a little bit different once again. And when I will only have right now, I only like to be working with like 5 to 7 people at a time. I'm working with 4 right now. So I've got 3 spots right now. What it is basically for 10 weeks, we jump on a live Zoom call, just you and me, one-on-one, going through implementing things, making offers, helping you with your capital raising, working on your pitch deck. I'm going to give you the front of line access. We're going to give you a list of our 12 hedge fund managers that send notes out to us on a regular basis so you can start getting deals sent to you directly, not from a joker broker, not from some website, but direct from asset managers that send us stuff. Okay. We're also going to give you our email database of 5,000 asset manager contacts. I know, crazy. That's worth a whole lot more. It says 8 weeks of one, but we actually do 10 months. Sorry, not 10 months, 10 weeks. After 10 weeks of the one-on-one coaching calls, you have a little bit of homework to tweak, but not too much. 4 or 5 hours a week. So if you do a little bit each day, you'll be good to go for the next week. And everybody's a little bit different. Okay. But our goal during that 10 weeks of calls is for you to close your first deal, raise money, close your first note deal so you're making some money back. Okay. We've had people closing 5 deals in the first 30 days, 20 deals in the first 90 days. Okay. Phil Brodeur, who's a Canadian investor, he's ready to come down in the next week or 2 for his 2-day in person, which is what we do after the 10 weeks. 10 weeks of Zoom calls, then we have you come in and spend 2 days with me one-on-one. Okay. Phil just closed on his second note deal. He closed on his first note deal in 30 days. He had more accepted. We ended up canceling a couple. Second or third deal just this week. Okay. He'll close on probably 50 before the year's out. He just said aggressive. John and Veronica closed on 5 in the first 30 days. They've closed on 24 in the first 90 days. All right. Cal Ewing closed on 2, 3, or 4 deals in his first 90 days. Okay. Taylor Schultz, who's out of New York. She used to work as a note trader, took my coaching. She closed on 5 or 6 deals in her first 8 weeks. Okay. Individually raised capital, stuff like that for you. I want you to close deals. That's why we close notes, not we talk notes. That's big. No, you're not paying me wholesale fees or market fees. You're buying direct, and we're holding your hand through the entire process. Okay. After you come and spend 2 days with me, we usually schedule a 1-day or half-day follow-up call. What ends up happening is a lot of the students say, like, oh, we'll just do a little. You got time for a phone call? You got time for? Can you look at a deal with me? Yeah, let's look at it. Okay. Once again, this is not somebody else who talked with me. Cal Ewing, who's been an investor for over a year, is closing on a deal. Asked me, hey, you got time for a quick phone call to go through it? Yep, sure do. I'm here for you guys. We'll help you find your first deal, if not more than that stuff. Now, this is a little pricier. It's $25K for a full year on this stuff. If you pay in full in 30 days, we drop this down to 20. We do have payment plans available for you guys. We also have a third-party company that will finance this if you've got a job for 2 years, a 620 FICO score, and what else? 620 FICO score and 2-year work history. You're making like 40 grand a year or more, they can probably finance it and make your payments down to like $500 a month. But here's the thing. The most important thing you need to do is take that 3-day class. That's the next step for all of you that are on this. If this is something you're serious about, I get it. You paid $3,000, you paid $1,500, you paid $4,000 for a class you learn with. I get it. I'm sorry you lost that money. $498, take the class. You will not be disappointed. And here's one thing, we give you 100% money back guarantee on the class. If you sign up for the class at the end of day 1, it's not the most impactful thing that you've taken, just let me know. We'll refund the $498 back to you. No questions asked. Okay. But if you want to do this, and note investing is where you want to hang your hat and dive into it, you got me to help you out. You got me on your team. You got me holding your hand and being your safety net so you're not making a mistake and you're comfortable and you know what to say. And that's worth a whole lot more than that. Okay. So if you're interested, get signed up today. Notebuyingfordummies.com. That special code is weekend to get it at half price. If you got some questions about that, reach out to me. talkwithscottcarson.com. That's talkwithscottcarson.com. If you need to break that payment up into 2 payments because of paycheck, stuff like that, I get it. Let me know. There's ways we can help you out to get the ball rolling for you. Okay. Because I'm a big believer that note investors, we see deals 6 to 12 months ahead of everybody else at better pricing and less competition. Yes, there's more note investors these days than there was 10 years ago, 20 years ago, but still a far smaller percentage than everything else. Okay. Any questions, any comments, concerns before we let you go on this Saturday so you can go enjoy the rest of your Labor Day weekend? Great, then. I just want to say thank you for all of you joining me for today. It's been a pleasure. If you're watching the replay on this, thank you again. As always, if you need to talk with me, talk with scottcarson.com. Sylvia, before you go, I need you to text me your number. The number that you registered with isn't working. I don't know if it was off by a digit. I tried calling you this morning to make sure you got the Zoom link and it wasn't working. So all of you guys, my personal cell phone is 512-585-3810. Let me type that into the chat roll. So, because I don't know anybody else is going to give you their personal cell phone, 585-3810. I encourage you to text me with questions. Prefer you go to talkwithscottcarson.com and book a call there. That's the easiest thing. Okay. But I'm here to help. Have a great rest of your week. And we'll see the top. Hey, Ashton, good to see you, buddy. Everybody that joined us live or watched the replay, thank you so much. Be safe, and we'll see you all at the top, everybody.